Hit it.
It's Friday, January 28, 2022, episode 166. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we have a great pleasure to welcome to the show Joseph Wang, the Fed guy himself. If you want to understand the inner workings of the Federal Reserve, this was one show you don't want to miss. And stay tuned for a surprising prediction of what might happen from the upcoming quantitative tightening campaign. In Talking Charts, Patrick once again mistakes squirrels for prairie dogs. What do you expect from an Ontarian?
And then we end with their segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We've got a great show. Lena, hop on. What beer are we drinking this week?
So this week we are drinking Kilter Brewing Company's Slurpee Slushy Sour Ale.
So this one comes from my buddy Paul from Winnipeg. And Paul is... For those who don't know, Winnipeg is the Slurpee capital of the world. We'll talk about more about this in the after show. And Paul is someone that I've had the great fortune to come to know. I didn't know him when I lived in Winnipeg, but he found a Slurpee beer for us. So why don't you tell us about the beer?
Oh my gosh, sorry. I just took a sip and it was very tart. Oh. A tart and fruity slushy sour ale brewed with a fresh blast of cranberry, orange, and vanilla. It's considered strong beer, 6%.
It's a sour beer that's disguised as a Slurpee. This isn't.
It's pretty sour, but it's not bad.
I think this would be good if you had it in the freezer for a little bit.
I do enjoy these types of beers. I like them when they're a little bit lighter for the summer drinking. This seems like a very kind of hardcore Winnipegger kind of beer.
Yeah, well, we'll talk about that a little bit as well.
And it's also vegan.
All right. Hey, Lena, do you have anything to plug on the merch store?
Well, please show us some love at markethuddlemerch.com. Oh my gosh, this beer is so sour. I can't speak properly. Get your Lord of Crayons hoodies. It's up now. You can get a hoodie with Patrick's face on it. And if not, please go get yourself mugs and our pint with Market Huddle logo where you can put your cold beer in every Saturday morning.
Ooh,
every
nice.
Saturday
morning. That's right.
There we go. All right, let me do my side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include dollar fixation disorder. Don't worry, Patrick. I'm sure there's a pill for that. Vixomia and the irritable Fed syndrome.
Oh, that's awesome. All right, let's get to the interview.
Okay, it's our great pleasure to welcome to the show Joseph Wang. Joseph is, he's a man of many skills, of many different backgrounds in terms of what he studied. But the thing that interests us most is he's a former trader on the Federal Open Markets Committee board. Or not board, what is it? What would I call it?
The Open Markets Desk.
The Open Markets Desk, that's it. Oh, you're right. So, Joseph, welcome to the show.
Hey, thanks so much, Kevin. I really love your show. Honestly, the first thing I listen to every Saturday morning. And so I'm really honored and delighted to be on it.
Oh, well, it's a real pleasure having you on. And just for those, I completely flubbed the opening, but just for those who are interested, Joseph, you have a blog and you have a website. Why don't you tell people about that before we even start?
Sure. So you can find out my latest writings on fedguy.com. I blog about what's happening in the markets from a perspective, focusing on a perspective from the central banking aspect and understanding the monetary system. And I also have a book called Central Banking 101, in case you're interested in more of the details and how the monetary system works.
Well, that's fascinating. Okay, so before we start in talking about all the nuances of the central banking and open market committee, open market operations and things of that nature, why don't you tell us a little bit about yourself? First of all, did you always want to be a trader on that desk?
No, actually. So I have a very unconventional background. I went to school and I did very well and I didn't know what I wanted to do. I only knew two things. One, I would like to have a job that made a lot of money and, a fancy job. I guess it's common for most kids to want that, right?
Right.
So in my 20-year-old mind, what was that? Well, let's be a lawyer. That sounds fancy, right? Yep. So I went to law school, I graduated, and I did end up at a big law firm, had a big fancy office in Midtown, in the middle of Manhattan. Great views, made a good salary. But the problem was I realized that, there's more to a job than just, making money. You actually have to like what you do. And I did not like what I was doing. And it was my first job out of school. And I just realized I did not really want to be staring at, let's say, 200-page contracts, chasing commas for the rest of my life.
Yeah. So you were a corporate lawyer?
Yeah, I was a corporate lawyer. So,
And so where did you grow up though? And where did you go to school?
yeah, so I grew up in the States. I lived in the States until I was 10 years old.
Yeah.
And then I moved to Taiwan and I lived there for 8 years.
Oh, okay.
And then I moved back and I went to college in the States and graduate school in the States.
Okay, so you're a lawyer, you get this fancy job in New York, and then you decide you don't want to be a lawyer. So how long did you last as a lawyer, by the way?
Yeah, so I practiced for a few years. So I started out basically when the financial crisis was happening, and I was sitting in my desk just chasing commas, and I was watching all this exciting things happening in the markets. I was watching, the Dow cratering, people panicking about what the Fed was doing, and that, seemed really exciting. It seemed much, much more exciting than basically writing term papers for the rest of my life. And so I was like, I want to do that. And
Okay.
the problem was, I'm already a lawyer, and there's a financial crisis happening, and there's the street is full of laid off traders and bankers, right? So it's not a very good time to start in the industry. So I wasn't sure how we could make that jump. So I practiced law for about 4 years, and then I realized that I don't want to do this my whole life. If I want to change, I have to do it now. And so I made the drastic step of just actually going back to school, and I didn't really want to do that. It cost time and money, but I wanted to change. So I went to graduate school in economics, and afterwards,
Did you stay in New York City? I'm sorry.
No, so I did my master's in the UK. So,
okay.
Yeah, at Oxford, and then I came back to the States where I worked.
That's a fancy school. That must have been quite the culture shock, though.
No, it was actually super cool to go there. And yeah, you're right. It was basically like going to school in Hogwarts. Tons of interesting history. So, when we take exams at Oxford, everyone has to wear something called a subfusk. So it looks like one of those graduate student gowns you would wear at graduation. And
come on, really?
No, everyone has to wear one of those. And just so you take exams in this giant exam room, and in order to get in, everyone has to wear their proper subfusk, has to have like dark socks and so forth. And there'd be this very stern-looking lady outside the exam room, making sure that you're wearing the right outfit, or else she would not let you in. And so all of us, we were very scared that we would, maybe wear socks that didn't match and get sent home, and then we wouldn't have time to finish the exam. So it was a serious thing. They take their traditions very seriously.
That is a funny story. I had no idea there was a dress code for exams. It's like my kids going to school and they get sent home because they're not wearing the proper outfit. That's hilarious. So you go there. Do you instantly like economics a lot better than law?
So I studied econ and math in college. So it was something that I was familiar with.
Okay.
It was actually a lot harder than I thought, since I did law for so many years. Basically, I had to do math again for first time in many years, and I looked across my class, and basically everyone was straight out of undergrad, did engineering, did math, or did quantitative economics. So it was a challenging time, but I passed, and so I went back to the States, and I got a job as a credit analyst. So I worked as a credit analyst at S&P for a few years, focusing on securitized products. But
there's lots to pick through in terms of post-great financial crisis there.
It's a changed place, really. It's a changed place. They would tell me stories about how things were during the GFC. Things apparently were much nicer. They would have basically huge snack bars. It was like eat whatever you want, and nice dinners all the time. And then now, when I was there, it was very austere, and people were very serious and solemn, and they're like, yeah, we don't have the budget for this.
The days of just rubber stamping every CDO squared that came through and putting a AAA on it were gone.
Yeah, they were long gone. They were long gone. But it was still a good business for them.
And did you find that I'm curious about that part, because there's lots of complaints that during that period, almost credit was too tight. And we went from being super loose with all of our ratings and all of our handing out stuff to being too tight. Did you notice that at the S&P as well?
So I think there's a couple points I would make, in that when I compare what I was doing then to what was doing before the crisis, it's just night and day. For example, in the securitized products segment, we would have to run these cash flow models about modeling basically how the assets would perform under the waterfall. So if you're a securitized product like an ABS, you have a set of assets, and those assets flow down a waterfall into different bonds. Let's say A1, A2, B1, so forth. So we would model that according to stresses like prepayments, defaults, and so forth, and different triggers. And we would do that in house to see whether or not, let's say, the A tranche merited a AAA rating.
Right.
Like before the crisis, like S&P would not do that at all. It would really just be the bankers who did that. So that we would just say, hey, bankers, could you run this stress test for us? And the bankers would come back, yeah, we ran it. No problem at all. And so I'm like, oh, okay, well, since you told us that way, I got no choice but to give you a AAA. So there was really no
comparison in the two.
Yeah, no verification. It was a much more rigorous process.
And what did you find in terms of that's a lot of math, and that's a lot of, you're a lawyer, you haven't seen these things. That must have been really getting thrown into the water, not knowing how to swim.
Just another point about the S&P thing. So one of the things that I noticed in doing deals is that the issuers, the banks, they would still shop around. So oftentimes they would call us, give us, let's say, some preliminary information and see what we could get them. And then they would also call the other rating agencies. And if they could get a better rating from another agency, then they'd be gone. So there is still competition among the ratings agencies just to see who could offer a higher rating to the issuer. So that is an impetus for.
Isn't that kind of crazy? Like you eventually go on to work at the Fed, but you got to just sit there and think about that whole process that they're shopping around for better ratings. It's just so fraught with peril. Like that, it seems crazy.
Yeah, it does. And the thing about this is that from an institutional standpoint, you're kind of just investing according to your mandate, right? So you have a mandate that you can only own something that's a certain rating, and you obviously don't have the time to do all the due diligence yourself. So there's a heavy reliance upon the ratings agencies. Hopefully things are a bit better now. They are regulated now, so they have to have some kind of justification for their rating. So that improves it a bit. For myself, coming from a law background and then going to graduate school and then coming here, it was a change. So instead of just doing research, writing reports and so forth, I was basically scripting and building models. It was a lot of computer programming. It was actually refreshing to me. So I like working with things like that more than just writing long, boring documents.
Was it all Excel? Or were there actual other models?
No. They've advanced. So they use. Actually, I work in different languages since I've done some stuff on my own. But at S&P, they have their own proprietary scripting language that they use to model the assets and the liabilities of
really?
Of the securitized products. Yeah, I think it was basically a legacy choice that they made. It's not the best language, but it works.
And just as a little aside before we get on to your time at the Fed, you mentioned that you work in programming languages. Now, what are those languages, and why do you do that? Like, why not just use Excel? I'd love to hear your thoughts.
Yeah. So, I work a lot in Python. So that's what I like. It's because a lot of the data sets that I work with are very large. And later when we talk about my time in the Fed, I'll talk about a little bit more about that as well. And that a lot of the data sets today, they're just, there's millions of rows, and you really wouldn't be able to do that in Excel. It's much, much quicker. And also, you can do a lot more things with it. It's much easier to reshape it, even if you were simply to reshape a data set in a programming language. It doesn't have to be Python. It could be R, and can even be Stata. But it's just a lot easier to deal when you deal in large data sets.
With large data sets,
there's a learning curve involved. But once you get past that curve, things become much, much easier. When I was at the Fed, so I did a lot of data analysis there, and I would always teach our newcoming analysts to use Python. And I've taught many generations of analysts, and sometimes they're like, yeah, this is great, but so much slower, and then they go back to using Excel. But the people who persevere, though, after, let's say, a few months of just slogging through, just kind of grinding through, the productivity you can get from just using a programming platform is just so much more than Excel.
Joseph, you've hit the problem that I have on the head all the time. I go and I promise myself I'm going to do my I use R. So I'm like, I'm going to do this in R, and I go and I have all these great intents, and I go and I do it, and I find myself going and having to learn stuff. And it takes way longer than just whipping it off in Excel. And then inevitably I just got to whip it off in Excel. And you're right. I got to just push through that. You think it's 3 months? You think 3 months?
You just need a project. You just need a project. That's all. Something to work towards. And once you get that first few months, it's like riding a bike. It's hard at first, and then once you get on it, it's smooth sailing, and you can't imagine just walking around anymore.
That's right. That's a great analogy. Okay, so let's talk about your time at the Fed. You're at S&P, and obviously you have higher hopes and aspirations. How do you go about getting this job at the Fed? Walk us through that whole process.
So I actually don't know. I just knew that I wanted to do something much more macro than just doing securitized products. So I applied to a job at the Fed. So I was aware that the open markets desk was kind of this place where you could learn a lot. It's kind of one of the centers of the financial world. So I applied to this job. It was for money markets desk there, and I didn't know anything about money markets. Vaguely knew something about the desk, that it was an interesting place. They were looking for people who had good data analytical skills. So for whatever reason, they gave me an interview. I showed up, talked a lot about all the data stuff that I did, and they gave me an offer.
There you go. And so why don't you tell people what that desk is? Because I don't think a lot of people understand that although there's a whole bunch of regional Feds, there's in terms of, there's the Dallas Fed and the San Francisco Fed, but the New York Fed is where all the transactions are done. And at least that's my understanding. Why don't you tell people how it's really the hub of finance?
Sure. So the open markets desk is the Fed's trading desk. So it's the desk that does QE, does all the repo operations, and it does the intelligence collecting for the FOMC. So what happens is that the desk has contacts and a bunch of data. So contacts throughout the industry, from, say, big hedge funds to banks, investment funds, foreign central banks, and so forth, that it speaks with regularly to get their perspective of what's happening in the markets. And then it passes that on to the FOMC. And it also has access to a lot of, let's say, supervisory data that people wouldn't usually be able to have access to. So let's say the regulatory liquidity portfolios of banks, or transactional repo data, things like that. So the desk is in a position to be able to have a very good view of the inner workings of the financial system. So when you see, let's say, something blows up, the desk is in a position to have, I guess, the best story that you can get out of any place, because it has so much information, and it uses that to inform the policymakers at the Federal Reserve Board as to what's happening.
Okay. And so when you're hired, what was your role initially?
Yeah, so I was hired as a trader on the money markets desk, and I had no idea what money markets is. I had vaguely some notion that it was what really old people put their money in, right? So I show up on the desk, and everyone's like, "Who is this guy?" And he doesn't know money markets. So they put me in my desk, and they put a big book called Stigham's Money Markets, and they're like, "Hey, you read this." And so the Fed being government and all that, so I didn't really have a computer when I first showed up, and I wouldn't have a computer for 3 weeks. So I just, I'm a new guy here. I sit in front of my desk. I read Stigham's religiously, hoping not to feel too stupid, because I'm new to this field. And I do read Stigham's, and I still don't get what money markets is. But after being there for a few years, I've come to realize that it is actually one of the foundational things in the financial system. So money markets is basically the funding markets, basically how the plumbing of the financial system. And when you're on the desk, you get to understand how banks work, how, let's say, the shadow banking sector, like money market funds or dealers, work, how the repo market works, let's say how the unsecured money market CP/CDs work. That is basically how short-term rates work. And that's, in my view, is the building blocks of kind of the entire financial system.
Okay, so I have so many questions, Joseph. I don't even know where to start. Okay, let's actually let me just, before we go on to actual transactions, because we'll go through some transactions, talk about how they work in real life as opposed to just kind of on Twitter. I'd love to learn a little bit more about the portion of the desk where you say it's collecting information. and you say that they talk to large banks, hedge funds. What sort of information are they looking for? Like, would you be sitting there and saying, "Oh, I see that this bond's trading special. I'm going to phone the trader up and find out why it's trading special." Is it that minute, or is it more just general things?
It's all that. So sure. So if you're on the desk, you have a direct line to all the primary dealers, which are basically all the big banks. So
Right.
anytime you can call up a dealer at any of the primary dealers, you can ask them what their thoughts are. Why is this trading special, or what do you think is driving this price action? And so yeah, that it is that minute, but more big picture things. For example, when we were doing quantitative tightening a few years back, we would have discussions with like the highest people in big banks, like the treasury or the CFO, about what they perceive would happen if the Fed shrinks their balance sheet, how that would affect their reserve balances, things like that. So it really does just run the gamut. It has to do with whatever is happening in the market and what the Federal Reserve is interested in at the time.
And is it on a daily basis? Like, is there a report written up every day about what the action happened today?
Yeah, there is actually. It's so every day. So our workflow is like this. So every day at there's two calls we have with the Federal Reserve System. The first call is at 9:05. It's called the operations report. That talks about all the operations the Fed is doing. So let's say treasury purchases or MBS purchases or repo transactions and so forth. It's more of the mechanics of how the financial system works.
Okay.
And the second would be the global financial markets call. So that we talk about macro. So we would have some guy who basically was in the office starting at 4 a.m., figuring out what happened in Europe, figuring out what happened in Asia, and he would write a report, and we would report that at a 9:20 call. So that's basically our daily product that we would offer the Federal Reserve System.
Okay, and that would just talk about color about what's happening out there in terms of specifics of markets. Like, would it be like the curve steepened here? Europe went offered at this price. These guys raised. It would just kind of be across the board what you'd expect any regular kind of macro trader to be interested in.
For the global markets call, yeah, that would be it. The operations call would be different because it would be all basically mechanics that no one would have access to. So that would be different. But the global markets call, yeah, it would basically be like a daily sell side note, except that it would be based on intel that we would talk to through the dealer network.
Okay. So it would be stuff that you've been collecting and just aggregate it all into one place so that everyone know it to kind of share.
Yeah. So let's say the guy came in at 4 a.m. He's like, well, crazy things are happening in Europe. So I'm going to call up some banks in Europe. What do you see here? What do you think? And so that would go into the report. And ultimately, it goes to the Federal Reserve System.
Okay. Now it goes to there on most of the times that you're just staying abreast of the information. There's no decisions to be made in terms of changes to any sort of policies. Is that correct?
That's right.
Yeah. Okay. So let's now start talking about the different operations and what that desk does. Okay. So I actually love to talk about it even before quantitative easing and before the zero bound, because I think a lot of people don't understand that aspect of it. So let's just imagine the world before we hit zero, before we had an interest on excess reserves and all that stuff. What would be the process upon which the Federal Reserve would change rates and keep the front end of the curve pinned to their target?
Yeah, so pre-GFC and post-GFC is like a completely different world.
Yeah.
So post-GFC, like the desk is so much larger because now we're doing treasury operations, we're doing a lot, like $1 trillion of repo, we're doing a bunch of agency MBS purchasing. Pre-GFC, it was really just it's like five guys in a spreadsheet. So every morning, no, they literally use a giant spreadsheet. So what would happen is that the Fed controlled overnight rates. That's the policy rate for the Fed, controlling overnight rates. They would control overnight rates by adjusting the level of reserve balances in the banking system. So back then, the Fed operated what was called a scarce reserve framework. So they understood the demand function for reserves in the banking system because banks had to hold, let's say, by regulation, reserve balances. So they understood that through their giant spreadsheet of all the banks in the system and how many reserves they held. And they had a target that they wanted to hold so they could control the supply of reserves. So knowing what the demand for reserves was, and then just kind of shifting the supply of reserves through their repo operations every day, maybe by a few hundred million, they could change the effective Fed funds rate.
Now, you say they did it through repos. I thought that they actually bought and sold bills and securities to change it at times. Am I wrong?
They could do that, but it was primarily through repurchase agreements. So, I mean, it was
that was the tool that they used. And
yeah.
And why don't you tell people before we go any further what a reserve is?
Yeah, reserves. A lot of discussion about that. Reserves are honestly just digital dollars. They are CBDC, quite literally. The difference really is that in order to have a reserve, you have to have a wallet at the Fed. So I'm speaking in crypto speak. So you have to have an account at the Fed. So what you think of as money in the financial system really depends on who you are. If you are a non-bank, like let's say me and you, for us, money is a deposit at a commercial bank, a bank deposit. But if you're a bank, what you think of as money are deposits at the Federal Reserve, and that's called a reserve. And reserves are freely convertible to currency. So if a bank ever wanted more currency, they could just call up the Fed and say, hey, I want $1 million in currency. And the Fed would deduct $1 million from their reserve account and ship $1 million in currency over. So it's just digital cash.
Okay. And at this point you mentioned that the banks were they're reserve constrained at this point. Is that correct?
Yeah. That's correct.
So the amount of loans that they are able to do is influenced by their reserves. So when the Fed takes it as a repo and takes reserves away, they are able to do less loans at this point. Is that correct?
I think that's the theory, but in practice, I think it's a little more complicated. Because if the banks don't have enough reserves to meet the reserve requirements, they can always just borrow. So the constraint is really one about price rather than the quantity of reserves.
Okay, I was talking. Sorry, go ahead. I didn't mean to interrupt.
Yeah, another way you can think about this though is that, the banks figured this out in the 80s, is that if you were really constrained by your reserve requirements or something like that, you can always book your loans offshore, let's say in London. And so you would have this offshore book that was less constrained by domestic regulations. And so in practice, all these regulations that were aimed at controlling, let's say, the quantity of credit were not that effective. It was really much more effective later on to just control prices, control interest rates.
Ah, that's fascinating. Okay, so in the 80s, there was a way around the reserve constraints. Is that that the banks figured
so
out?
they figured out. Yeah, they figured out. So if I have deposits in the U.S., they're subject to reserve constraints. Okay, well, I'll ask my clients to book these deposits in my London office. Okay, problem solved.
Right. Okay. So now let's go on. We're going along with this system, and everything's somewhat okay. At this point, the Fed's balance sheet is quite small, at least compared to where we are now. And then we have the great financial crisis. And at that point, the Fed goes down to zero, puts rates down to zero, and finds that isn't enough to save the financial system and has to do extraordinary monetary policy. Why don't you explain how that worked and how that changed central banking forever?
Yeah, I like how you say that. It did kind of change central banking forever. The world today is so different from it was before. So, like you mentioned earlier, the Fed controls overnight rates, right? Controls the short rates, and that's their toolkit. So by being able to have strong control over the overnight rate and promising to commit to, let's say, maintain that over a certain period of time, it controls the short end of the curve. So if the Fed is saying that I'm going to keep overnight interest rates at 1%, I'm going to keep that like that for the next 5 years, this is being called forward guidance, then it could kind of make the belly up the curve all around 1%. But beyond that, when you're talking about longer dated rates, the Fed has a lot less control over that because who knows what the stance of policy will be in 10 years or 20 years. So the Fed was at a time where interest rates are at zero. It felt like the economy needed more stimulus and it wanted to push rates in the longer end lower. So the way that they did that was they went and they bought a lot of assets. They bought a lot of treasuries, tried to compress the term premium is what they would say. And that mechanically has two impacts. So, just going back to our discussion, it increased the level of reserves in the banking system, but it also increases the level of deposits in the banking system. And that has to do with just how our two-tiered monetary system works. Because, if you're a bank, you can hold reserves as cash. But if you're not a bank, you can't hold reserves. So what happens if I sell a treasury that ultimately gets bought by the Fed? If I sell a treasury that ultimately gets bought by the Fed, then the Fed creates a reserve out of thin air to pay for that purchase. That reserve goes into my bank, and my bank then turns around and credits, let's say $1,000 into my bank deposit account. So at the end of the day, the banking system has 1,000 more reserves and 1,000 more in deposits.
Okay.
And that has the impact, just purchasing these longer dated treasuries has the impact of pushing, let's say, compressing term premium, is how they would put it. But it also has some other impacts that I think we've all come to appreciate.
Right. Now, before we start, I'd love you to highlight the difference between what we thought was going to happen when 2008, when we started this, and what actually happened as well.
Yeah, I think back then it was all about hyperinflation, right? Gold, you look at the price of gold, it just went straight up. Obviously, the Fed was losing control, turning into a banana republic.
Right, and there was that famous op-ed in the Wall Street Journal signed by lots of very prominent economists and strategists saying that the Bernanke was making a huge mistake and we were going to get hyperinflation.
Yeah, still waiting for it. So I think their misunderstanding had to do with just they misunderstood actually how the monetary system worked. And I think, again, going to the point that what you think of as money really depends on who you are in the financial system. Now, if you are, let's say, a non-bank retail like me and you, we can put our money into a bank deposit. But if you are a large institutional investor or let's say a sovereign fund or something like that, you really can't do that. Your money is only insured up to the FDIC limits of $250K. Now, so I obviously can't put $1 billion into Citibank. So what happens is that you have to put your money into something safe and liquid. You want to put your money into treasuries. Another way to think about this is that, if you have a $100 bill is the currency issued by the U.S. government, $100 in treasuries is basically also issued by the U.S. government, but it pays interest. So it's basically a form of money that pays interest. Now, you can't obviously go and have a good meal, sit down, plop down some treasuries as payment. You have to convert that into spendable forms of money into a bank deposit. But in the same way, you wouldn't be able to use $100 in a vending machine to get Doritos. You'd have to convert that into smaller change as well. So the treasury market is such that it's ultra liquid. So you can freely convert your treasury securities into bank deposits or ultimately to currency. Every day, you have about $600 billion in cash treasuries being transacted, very liquid. And if that is not enough, there's also $1 trillion in repo done every day. So you can borrow against your treasuries for bank deposits basically instantly at ultra low rates. So these two markets together make treasuries freely convertible into bank deposits. So that liquidity makes it and risk-freeness makes it very money-like.
Okay.
And what the Fed was doing was ultimately, from a non-bank's perspective, just forgetting about the banking sector and the reserves and so forth, it was changing the composition of money available to the non-banks. There were fewer treasuries and more bank deposits. So if you had $1,000, so in the financial system, if you had $1,000 in treasuries, now you have $1,000 in bank deposits instead. So it wasn't so much as increasing the quantity of money as just changing the composition. But the composition matters, though, because these two forms of money are not freely substitutable. Bank deposits, 0% yield, and of course you take bank credit risk. So if you are a big investor and you need some return, you have to go maybe farther out the curve or slightly up the risk curve. So you can buy 10, 20, 30-year treasuries, or maybe you buy a bit more IG, maybe even more Apple stock. If you are so you have to do that.
Right. So
for return, and of course, if you can't take bank credit risk, you have to stay in treasuries. Right. So I think that this mechanical rebalancing is basically, in my view, a big part of how quantitative easing drives the asset prices. But now that was the non-bank portion, and this is a bit more in the weeds, but I know you have a professional audience, so it also increases the reserve levels of the banking sector. And for banks, they don't really want to hold all this zero-yielding reserves as well, and they would also rebalance, usually up the in longer duration, because they can't take too much credit risk from their regulations. And this is something that you've seen very clearly the past 2 years. Banks looking at their reserves that yield, let's say, 15 basis points, not liking that, optimizing by purchasing treasuries, so swapping reserves for treasuries or agency MBS. And that, of course, puts more downward pressure on yields.
Okay.
So you have basically this double effect that's happened through QE, through the portfolio rebalancing mechanisms of both banks and non-banks.
All right. So I'm with you. So we understand how that might affect financial asset prices. But at first, we used to think that would create real inflation. Why didn't it create real inflation?
So I think the argument, so the Fed, and like most economists, see the world through the lens of interest rates. So, if you do QE and you push down long-term rates, somehow you're supposed to get more growth. And that's an ingredient, but that's not the only thing that matters. So you didn't really increase the quantity of money. You changed the composition. But what you could do to increase the quantity of money, though, that would be inflationary, is if you actually printed more money. And that, for example, would be printing treasuries. So we didn't really see any big inflation, even though we did a lot of QE in the post-GFC world. But once we started doing significant deficit spending, we started to see a lot more inflation. So if you can accept that treasuries are a form of money, then when you're doing significant deficit spending, like $3.5 trillion, what you're really doing is you are buying goods and services and offering treasury securities as payment. And so you are quite literally printing money. And this is what people thought QE was, but it wasn't. Right. And when you're actually just doing this huge amounts of helicopter money, $3.5 trillion a year, then obviously you're going to have some inflationary pressures, which is what we see today. So I think that was the confusion.
Right. So the difference is, maybe I'll just try my explanation, is that when you do quantitative easing and the Fed buys bonds from, let's say, J.P. Morgan, that doesn't make J.P. Morgan actually any more likely to make a loan to a mortgage, to write a mortgage for a house, or to lend money for CapEx. So in essence, it gets almost stuck within the banking system, and eventually it just comes back and sits on the Fed's balance sheet because there's so many reserves out there that it actually pushes down, and that's why they had to make the interest on excess reserves. Am I correct?
So I would note that reserves can only stay on the Fed's balance sheet. Like it's a closed system.
Okay.
Let's say if you're looking at Bitcoin, a big blockchain, right? There's only, let's say, 20 million Bitcoin, and no matter how many times you make a transaction with Bitcoin, that total amount doesn't change. So that's the same thing with reserves. It stays on the Fed's balance sheet. You're only shuffling it between accounts. The connection between reserves and bank loan creation basically doesn't exist, because if a bank ever needs reserves, they can always borrow it. So that's not really a constraint. I think in the 1980s, you had a more monetarist view of how the monetary system worked, and they were thinking that if you injected reserves, you would have more money creation and so forth. But they abandoned that when they realized that it was really more about controlling the price of money that was more effective. So in the post-GFC world, the banks did not create a lot of credit. And like you mentioned, but it wasn't so much because of any lack of reserves. It was just had to do with the state of the banking sector at the time. I mean, we were going after the GFC. Banks were not in good shape. They had suffered lots of losses, so they weren't really in a position to make a lot of loans.
Right. So sorry, I didn't mean to interrupt.
Sorry, just as another overarching point. So again, when you have more money in the system, so obviously money is purchasing power, it's demand. So it pushes up, let's say, the demand for goods and services and financial assets. So I've been talking about how you could, let's say, deficit spending, you would be basically printing treasuries to purchase stuff. But money is also created by commercial banks, and that is the dominant creator of money. Most money that we see in the economy, bank deposits, are created by commercial banks when they create credit. So to think about whether or not banks are creating credit. That, like you were asking, is right on the money.
Right, and the way I also explain it is that in the 40 years after Paul Volcker broke the back of inflation, they were able to encourage or discourage that private sector credit creation at will. But in doing so, they encouraged the private sector to take more and more debt until they hit a point where they could no longer encourage the private sector to take any more, and that was the zero bound. And at that point, they thought that the quantitative easing was going to cause this hyperinflation, but it really didn't. If there's no demand for loans or credit available, it really doesn't do much except kind of change the composition of the balance sheet, as you note. But then I love the fact that you're bringing up the COVID crisis and you talk about the fiscal. And I would love to hear your thoughts about whether the Fed understood the need for fiscal even during the great financial crisis. I know that Ben Bernanke begged the Congress to spend a little bit during that period. But when do you think that kind of concept that it's not the monetary policy can't do all the heavy lifting was finally accepted by the central bank community?
Yeah, that's a good point. In the post-GFC world, all you hear about was austerity.
Right.
You're over indebted. You have to stop spending, and I think that did not have good results, and that has fundamentally changed. I don't know if it's led by the central banking community in so much as it's led by the legislator. I mean, the legislator seems to have a knack for spending money, and certainly deficit only goes higher. And I think they've just come to realize that all the warnings that the economists have given them in the past were basically not true. I mean, you didn't have massive inflation, bond yields still seem low. So I think and you have this new school of thought called modern monetary theory, who seems to tell people that it's okay to just keep spending money. So I don't know if it's led by the central banking community in so much as, you have a school of thought saying that it's okay to spend a lot of money, it's good to spend a lot of money, and you have legislators that really want to spend a lot of money.
So would you argue that not Greenspan, I'm showing how old I am, Bernanke understood that his ability to affect the economy through monetary means when the fiscal was getting tamped down so badly post GFC was going to be limited?
I don't know. I don't know. I think Bernanke, from what I read, was a really smart guy. I think he did a good job. I just don't know what he was thinking that time.
Yeah, okay, fair enough. That's kind of a crappy question to ask you. Okay, so let's go to the...
I would say, though, from my experience, I would not assume people at the Fed to know a lot of stuff. Ultimately they're government, right? So I wouldn't give them assume that they know many things.
Okay, so that's actually, I was going to ask you that later in the interview, but since you brought it up, let's talk about that now, because you'll often hear Wall Street complain that the Fed doesn't understand, that they don't get it. And I've heard different arguments. I've heard people say they're much sharper and much smarter than you think. They're just, they have a different mandate. They operate by committee. It takes longer. Wall Street is quicker. It's private sector. And then, there's also the arguments that they're just complete bozos, don't have a clue what's going on and couldn't beat their way out of a wet paper bag. Where do you come down?
Yeah, I agree. There's just a wide range of opinions. Is the Fed full of idiots, or is it full of just these Machiavellian people who are behind the curtain, just kind of trying to control the world, right?
Yeah.
So Fed is government. I think it's much more post office than bank. You can think of it as basically a business that can't fail, run by people who can't get fired. I was actually quite surprised by the level of expertise on the desk. So when you're talking about the staff, senior staff, they're pretty sharp and they do a great job. But once you get to more senior levels, people who make big decisions, that level of expertise just kind of falls down a cliff.
Okay.
So when I was on the desk, the person who headed the treasury markets desk, person who headed the money markets desk, literally no expertise in the subject at all, none at all. Now, person who had the secured money markets, no expertise at all. Person who heads unsecured money markets, no expertise at all. What happens is that because you can't get fired, and because people who got there first have all the power, people who got there first basically end up owning the agency. And so if you own the agency, you have a tendency, I think, from my perspective, to kind of run things for your own benefit. And so they just kind of just, it doesn't really matter what they do. I was at the New York Fed. It's not part of the federal government, so there's no oversight. It's not really a private sector entity since they can print their own money. So these kind of just, did whatever, and nothing seemed to matter. They would just kind of staff their positions with their friends and just kind of bumble about. I mean, I actually remember in 2018, so the senior management was like, you know what? We're creating a whole new tier of management, and it's going to make this organization so much better. And we're going to start interviewing for people for that position. And then that took 6 months, and they're like, yeah, we got all these great applicants from the private sector. It's going to be great. And so many people are interested in these super senior management positions. And then a few months later, big town hall meeting, great reveal. So we looked through a lot of candidates, and the new manager, it's me. So all management positions went to current incumbent managers. So I got the sense that they basically just created a whole new tier of management to promote themselves. And so stuff like that happens like all the time. Like no one really knows or cares about anything. The staff, though, the senior staff are very talented and great people, and they usually go off to Wall Street and, let's say, triple their salaries. But the people who actually make decisions, I thought it was fairly concerning about the level of competence.
And then what about the governor? Are they called governors? What are like the?
Yeah, so there are presidents and governors.
Yeah.
So that really depends. And so we can have very smart and competent governors, like, let's say, Richard Clarida, spent a decade in PIMCO, professor at Columbia University. I've heard him speak. He's sharp as they come, very experienced. Or you can have, let's say, people who are more like political activists. So it does depend. So I think the appointed people can be better, but it really just depends. When I look at the new slew of appointments, it's possible that, political considerations take precedence over some more practical considerations, because you don't really see any of the new nominees having any experience in monetary economics, or even, let's say, experience at a financial organization.
Okay, so I'd love to talk about QE and during the COVID crisis, because I was absolutely floored about the size of the QEs. And I used to tell people, I'd be like, these numbers are just crazy. I used to get the sheets of all the transactions they were doing, and it was just shocking to me, the trades that were occurring. And I was trying to stress to people how big it was, and it was hard to get your mind wrapped around it. And you would just look, you'd be like the two halves of 2041, and you would see they bought 500 million, and then you'd look at the next issue and they bought 342 of that issue. Tell people how that worked in terms of like a real boots on the ground. And you weren't there at the time, but you can probably imagine.
No, I was there.
Oh, you were there. So you
were... it was one of my highlights.
Okay.
Being on the COVID time was one of the highlights.
Okay.
That's
well, listen, I didn't realize you're there. Tell us, give us as much a play-by-play in terms of how it went on the desk, in terms of as the crisis began, and what you guys started to see, and how when you got scared, and then they're like, just any sort of color, we'd love to hear it.
So that was an exciting time during my time at the Fed. So if you remember that I mentioned that we have these daily calls we have with the Federal Reserve System. Usually they're not that well attended because there's not much going on. But that week when I was doing the call, so many people called in that our conference bridge just broke. It could not handle it. And there was just that week in March when everything was coming down. So when you're at the Fed, when you're on the desk, you focus on basically the functioning of the market, right? So if you're thinking about money markets, you're thinking about basic funding. If you're thinking about treasury markets, you're wondering if the market is still, you can still buy and sell, right? And all of that was breaking down. So in terms of the money markets, that's important because potentially there are banks that can't get funded. So in the financial system, a lot of financial entities, be they banks or shadow banks, like let's say a money market fund, they operate under a regime where they have short-dated liabilities and longer-dated assets.
Okay.
And so they depend on being able to roll over those short-dated liabilities every day to fund their assets. Now, if they can't do that, then they're going to have to fire sell their assets to meet the withdrawals, and that basically is very disruptive to the system. When you fire sell your assets, other people have to fire sell. Everything comes tumbling down. So you have a bank run dynamic. So when you see funding rates creep up, that's a concern. You saw that in the FX swap market. Let's say foreign banks or foreign investors who were buying US dollar denominated assets and hedging it. So those FX swap bases were blowing out. You saw that in LIBOR. LIBOR was blowing out. You had potentially some entities who were relying on short-term money market funding not being able to get that. But more importantly, and this never happened before, is that you had malfunctioning in the treasury market.
Okay.
Now, going back to the theme where treasuries are a form of money, so people hold treasuries with the expectation that they can convert them into bank deposits anytime they want. And for most of history, well, as far as I know, always is a true assumption. So you can think of this as basically you have bank deposits in your bank and you expect to go to your bank and being able to withdraw currency anytime you want. And so you can think of the treasury market in a sense as kind of this giant bank where everyone holds their money in treasuries expecting to be able to withdraw their money anytime they want. And in March of 2020, a whole bunch of people showed up at the treasury market expecting to withdraw their money from the treasury market by selling treasuries, and they were not able to do so. The reason being, of course, that the treasury market could not accept, it did not have the capacity to accept all that selling, or basically the dealers could not buy everything that was being sold to them. So they kind of had to stop. So this is similar to going to a bank and not being able to get your money out. Obviously, you would panic, and so many people did panic. And if you needed to meet investor redemptions and you couldn't sell your treasuries for liquidity, what do? Well, you got to sell anything else, right? So everything was sold, and that was really a fundamental break in the monetary system. The convertibility between different forms of money, treasuries and bank deposits, was broken, and that's kind of a classic problem that the Fed has to be able to fix.
When can I ask what day? Do you remember what day that occurred and how quickly it was fixed?
In March.
Like,
it's like the first, second, third, just first part of March.
okay.
I remember.
So so you guys notice what did that look like to you on the desk? Like you said,
yeah, dude. So when things don't go right, people call us. So you get a lot of calls from people all over the market just telling you that this is not right, something's wrong, and you get dealers coming and complaining, saying that the treasury market is broken, there's no liquidity, and so forth. So when that happens, there's really only one entity in the world that can come and fix this, and that's the Fed. So
Okay.
The Fed basically came in, and just like it would provide, so I'm using this analogy of the treasury market like a giant bank. So it would basically provide liquidity by taking some of those treasuries out off the balance sheet of dealers so that the dealers can continue to make markets.
Okay.
So in a sense that people could indirectly sell their treasuries to the Fed, who would buy them and provide them with liquidity. So
that they could go back to making markets because they couldn't make markets because they were getting overwhelmed and they needed.
That's right.
Like they had so much inventory, they had to pawn some inventory off on you guys.
Exactly. Pawn trillions.
Yeah.
Not a trillion, it's almost a trillion. And so if they can make markets, so they could be able to provide liquidity to the investor class, right? So if an investor wanted to sell what needed bank deposits, they would sell their treasuries. Now the dealer could buy those treasuries and provide them with bank deposits,
right,
to go and meet their investor redemptions. And at that time, it was just investment funds just throughout the spectrum, because there was such panic that all the investment funds were getting redemption requests from their clients and they needed to raise liquidity. And you also had many sovereign players too who would come in and well, there's demand of dollars globally, right? So if you are a foreigner, where do you get your dollars from? You get it from your bank, who in turn gets it from the foreign central bank. And how does the foreign central bank hold their dollars? In treasuries. So the foreign central bank sells treasuries indirectly to the dealer, gets dollars that they can then give to their foreign banks. Foreign banks then can give to their foreign clients who are clamoring for dollars because everyone was scared at the time.
So you're instructed at this point. You guys realize you have a problem. Is the first let's say wave? Do they just say buy everything you can? Like, how does it? Like, just walk me through how you go about buying. 500. What was the biggest purchase in a day?
Yeah, I don't remember. So I'll say this. So when you're doing it in an emergency, it's a little bit different than what the Fed does from a day-to-day basis.
Okay,
so
let's do the emergency though first, because it sounds like more fun.
Yeah, I think they were just buying everything. So I was not involved directly in the treasury purchases, so I can only tell you what I heard from other people. But they just kind of bought everything.
So
bought as much as they could.
Do they just phone up and ask for an offering and just
No.
Okay.
There's a process to do this. So if you're a primary dealer, you will have a special trading interface with the Fed. It's called Fed Trade.
Yeah.
And so your transactions are done through that interface. And so you would basically offer to sell the Fed stuff. It would be a competitive offering. So you got 23 dealers. Everyone is offering to sell the Fed something, and the Fed gets to choose.
Oh, okay.
Yeah. Oh, yeah.
So it goes the other way. They're offering, and you guys pick what you want to buy.
Yes. And
I didn't realize. I thought it would be the opposite. I thought you guys would bid, and then they would hit you.
So common misconception: Fed is just being dumb money and buying whatever. Maybe a little bit more true in the MBS market, where we take basically the most undesirable pools.
Yeah.
But in the treasury market, it's done through competitive auction, and there's actually an algorithm for this.
Oh,
very very simple one. So you look at the bid, you look at the offers, and you basically judge them according to what you get from the screens, the quotes, and also you have your own spline model. So you want to buy something that is at least reasonable. You don't want to be, buy something that's too expensive.
Right. Okay. And so they go through and they just pick it away. And so,
yeah.
And like, what were the kind of numbers in a day? It was in the billions, right? And it was,
no, it's like hundreds. It's like
hundreds of billions, right? Like it was
not hundreds, but almost 100 billion.
Yeah. Just monster numbers. Crazy.
Numbers, yeah. Like it was insane. No, it's something that's never been, numbers that you've never been done before, just like that.
And did it break any of the back office, or did everything run smooth in terms of settlements?
Yeah,
it went.
Worked. So
it went.
Yeah, it worked. So I mean, when you're doing like a transaction of 100 billion, like 1 billion, it's just a number on the system.
Right. I guess that's true. Whether it's 1 billion or 5 billion or 5 million, it's all the same, right? So it doesn't. Computers, it's all the different. Okay. So that's fascinating. What were some other kind of color from that period that anything else that really sticks in your mind about the COVID crisis being on that desk?
Yeah, it was. So I think what was, first of all, this whole thing was actually went fairly smoothly compared to, let's say, the GFC.
Oh,
because the Fed had so much more experience.
Okay.
In doing that. So, for example, Fed rolled out all its emergency alphabet soup lending facilities just right away, almost, right? So, back in the GFC, these things were had to be thought of and be planned, but once they're established, they're kind of on the shelf. And so during the pandemic, a lot of people were just able to take them off the shelf and just revive them. So let's say primary dealer credit facility, or let's say TALF for securitized products, all those things, they were basically active during the GFC, and you just kind of reactivated them. And so that was easier to come online. And of course, the FX swaps, which were probably the single most, after the treasury purchase, the single most important thing in solving the crisis.
So go ahead and explain why that is.
So the dollar system is a global system, right? So it's our currency, but everyone in the world uses it. The problem being, of course, that when we need dollars, the Fed is the ultimate lender of last resort. It can provide dollars for us. But if you are a foreigner and you're using dollars, let's say in Kazakhstan or in China, or let's say in India, you don't have any Fed there to act as lender of last resort. So if you're a bank there and you suddenly need liquidity, you're kind of out of luck. And that's where the FX swaps come in. It essentially opens up the discount window or discount window-like liquidity to a very wide range of banks. And you saw participation in that up to close to 500 billion, so close to $500 billion. So that was the Fed basically acting as lender of last resort for the global dollar system, even for banks who are abroad. And the drawdown was just amazing.
Now when the Fed does that, they do an FX swap with the other central bank. Is that correct?
Yep.
So they're taking country risk of the other central bank. So like I'm a Canadian. I'm sure.
I think you guys are good for it.
Yeah, but the Bank of Canada most likely had a swap line, and they would come and they would say, okay, we need $100 billion, and then the Fed would lend them the $100 billion. But is that and that's purely we're not exchanging collateral for that?
No, the Fed gets a deposit of equivalent Canadian dollars.
Of dollars, yes, but it's not like
Canadian, yeah.
But that's just an entry in a system, right? Like that's
So the Fed doesn't do anything with that money. It just sits in the Bank of Canada. So it's kind of a formality. I mean, so the Fed would not give an FX swap to a central bank if it thought that it would just kind of take the money and run.
Oh, no, of course. I'm just trying to understand that risk.
Yeah.
Now the other thing. Sorry, go ahead. Yeah. Finish up.
Yeah, there's no country risk because so the Fed has standing FX swap lines with their best friends, right? So ECB, Bank of England, Canada, and so forth. During the crisis, it was expanded to, let's say second best friends like Singapore or Korea and so forth. But they're always friends. So we would not have a swap line to, let's say, China, even though China is a very important part of the dollar world. They actually had come up with a special facility. It's not called, let's say, a special facility, but it's basically a facility intended for China. It's called the FEMA repo pool. You might have heard of it.
No, I've never heard of it. So how does it work? Is there collateral or something on the other side to make it?
Yes. So instead of just saying, an FX swap is, let's say, it's currency for currency, right? Yep. So I give you, so Fed gives Bank of Canada dollars, Bank of Canada gives Fed Canadian dollars. So if you're using the FEMA repo pool, it's a special repo pool, especially for sovereigns. So it allows a sovereign to convert treasuries to dollars without going to the market.
Okay.
So basically, it's a different type of collateral. The difference being, of course, is that if you're the Canadian Central Bank, you have infinite amounts of Canadian dollars. So it's never a constraint for you, right? You can have as many US dollars as you want because you can create as many Canadian dollars as you want.
Right.
But if you're like, let's say, another sovereign that doesn't have FX swap and you're using the FEMA repo facility, then you need to have treasuries first, right? So you can't just create treasuries out of thin air. You have to have the collateral in place.
Okay. Now, the other thing about the COVID emergency measures that was very controversial at the time was that the Fed expanded out of government agencies, mortgage backs, which is whatever, and FX swaps. They expanded it to include corporates. I would love to hear any thoughts you had about that, any insights.
So the Fed does lending in a couple ways when it does its emergency lending. It does it in an on-balance sheet way and an off-balance sheet way. So on balance sheet, the Fed makes a loan directly to the borrower. Off balance sheet, it does it indirectly through an SPV, and that's how all the riskier purchases were made. So the corporate credit facility was a new thing that they came up with to try to stabilize the corporate bond market. So recall from our discussion that there was a run on the treasury market. People who could not get liquidity from treasuries were selling everything, and that, of course, the problem cascades to other parts of the financial sector. So if you are a bond fund and you needed liquidity to meet redemptions, you could not sell your bonds either, right? I mean, obviously, if you can't sell treasuries, you definitely can't sell IG. So the corporate credit facility was there to provide a similar function to what the Fed did for the treasury market. It was there to provide liquidity. It was there to buy corporate debt. The way that it was constructed was that you would have this special purpose vehicle, this separate legal entity. The U.S. Treasury will provide equity to absorb first losses, and the Fed will basically lend money to this SPV to go and buy, let's say, corporate debt and maybe a sliver of high yield. And that facility was probably the most best bang for your buck that I've ever seen. I think they bought maybe a total of 11 billion or something like that. And the corporate bond market just kind of not just unfroze, but went bananas. It was just kind of rallied enormously. So I think people just perceived that the Fed was there, and the market just basically unfroze. And of course, before that, the Fed had also unfroze the treasury market. So sentiment was improving already.
Now, the reason for the SPV is that, my understanding is the Federal Reserve cannot buy assets that are perceived as risky, and that in essence, the Treasury had to guarantee to make sure that the Fed wouldn't lose any money on their purchases. Is that correct?
So that's definitely to lessen credit risk. But whether or not the Fed can purchase risky assets, I don't know, because, let's say you make a discount. Well, the Fed makes emergency loans to banks all the time, right? It's a discount window, so that has some risk. I don't actually view the Fed as actually having any real legal constraints.
Oh, okay.
So the government government makes the rules, right? So is there anything stopping the Fed from creating another SPV and just going to buy Tesla stock? If you can buy credit through an SPV, why couldn't you buy anything else? The constraint really is political will, whether or not, let's say Congress and the White House would be okay with it. So when I look at the Fed, I think of its constraints as political.
Okay, that's fascinating. Okay, now let's move on to quantitative tightening. But before we do, I think it's important that we talk about the reverse repo, the fact that that's gone up to 1.6 trillion or something like that. So why don't you explain to people what that is and what that is accomplishing?
So excuse me. So the reverse repo, you can think of it as a deposit account at the Fed. Going back to our monetary system talk. So let's say you pump the system full of reserve assets and deposits. So the banking system, let's say it's super full, right? Now, the problem is that banks have these regulations that limit how big they can get. So it's actually possible that you can go to a bank and they can turn down your deposit. Now, for you and I, it would never happen because you're retail. But if you're like an asset manager and you have $1 billion and you want to deposit at JP Morgan will say, hey, I'm kind of full. I don't really want your money, but I have this great product. It's called a money market fund. You can put your money there. And so what happens is, because QE was just so large that the banks basically ran out of room to hold deposits. And so they started pushing some deposits out to the money market funds. And the money market funds then have enormous amounts of assets, almost 5 trillion now. And so what do they do with those assets? Well, they don't really have any place to invest either, because they have so much money, there's nowhere to put it. So they end up depositing at the Fed in the reverse repo operation for 5 basis points. So it's, in my view, it's largely a function. The reverse repo operation is largely a mechanism to take care of the side effects of quantitative easing. So quantitative easing creates too many bank deposits in the system. Banks don't have room. They can push it off to the money market funds, who then deposit it at the Fed.
Okay.
So it doesn't really, I don't think of it as changing the, actually, you can think of it as changing the composition of money, whereas there are fewer bank deposits and more money market fund shares, which are also comparable assets from a non-bank's perspective. From the Fed's perspective, though, you can think of it as fewer reserves and a little bit more reverse repo loans.
Okay, now let's go through quantitative tightening, and let's talk about it when they did quantitative tightening in 2016 or 15. When did they start that originally? 17?
Yeah.
So let's go through the first example back then and how it worked. And were you there at that point?
Yeah, that was one of the main things I worked on, quantitative tightening.
Okay, so let's talk about it, and let's talk about it from the scratch. Because up until that point, there had been chatter that it had never been done before. If I remember correct, Japan has done quantitative easing, but nobody had done quantitative tightening. So the U.S. was the first to do it. So why don't you walk us through what you were thinking, how it works, the whole 9 yards?
Yeah, so quantitative tightening, I study this very closely, and so on desk. So if you are studying this on the desk, you have access to everyone's reserve accounts. You have access to basically everyone's regulatory filings. So you get to have, and you get to talk to their treasury desk. So you have a pretty good view as to what actually happens. So on a macro level, quantitative tightening just basically unwinds quantitative easing, right? At the end of the day, the banking system has fewer deposits and fewer reserves. The private sector, the non-bank sector, holds more treasuries. So the Fed, so on a micro level, the Fed owns a treasury asset, right? And the treasury is going to repay that. The way where does the treasury get money to repay that? It has to borrow from someone other than the Fed to repay the Fed. So end of the day, private sector has more treasuries. Banking sector has fewer deposits and fewer reserves. Now, from the non-bank's perspective, you can think of just changing the composition of money again. Fewer deposits, more treasuries. That obviously reverses the rebalancing effects of quantitative easing, so that could not be good for risk assets. But what the Fed was really concerned about at the time, though, is the decline in reserves in the banking sector, because it didn't really know just how many reserves the banking system as a whole needed. So the more you do quantitative tightening, the fewer deposits and reserve assets that the banking system holds. And it was possible that maybe you would be at a point where the banking system would not be able to function because it had too few reserves. And they were doing everything they could to try to understand how that would work. So they would come up with a survey, send it to a whole bunch of banks, basically call everyone every day, hoping they would fill it out, chase them down until they got good answers. And they would do this, a couple times a year. So to figure out, it turned out that they just kept doing quantitative tightening until sometime the repo market kind of exploded, and then it was interpreted that that was too much. So we got to reverse that and add more reserves into the system.
You say it was interpreted. Do you not agree with that?
So I think it played a role, but here's the thing, though. So from what I see, you're right. Everyone, it's obvious that the banking sector, when you do quantitative tightening, the banking sector has fewer reserves, right? And so the markets that are most impacted are the markets that were benefits of those reserves. So if the banks were taking their extra cash and they were investing it in the repo market, then when you decrease the level of reserves in the system, you're essentially pulling money out of the repo market, right? So in that sense, that's basically the direct impact of quantitative tightening from the banking sector. Markets that were recipients of extra bank reserves have fewer bank reserves. And at that time, the repo market was growing very strongly. And as an ever-increasing demand for repo financing was met with a shrinking supply of financing to the repo market, the market just hit an air pocket and everything exploded. I think of it as differently in the sense that I don't actually think the banking system needed that level of reserves, but the repo market wanted it. So the banks themselves, absolutely fine. The banks don't really borrow in repo, they're lenders. But the people who are borrowing from the banks, the hedge funds and the dealers.
The shadow banking system blew up.
Yes, it was a run at, you're exactly right. So it was a run in a segment of the shadow banking sector. Basically, some dealers were just levering up hugely in the repo market, hit an air pocket, and just kind of blew up.
You could almost argue that it was a positive development in terms of if you're worried about too much financial leverage.
Yeah, I know. I agree. It's good that people blow up every now and then, because then people, then you have risk managers come in, you recalibrate your risk models, and it's much less likely for it to happen again the next time, right? It's like feedback you get in real life. You fail sometimes, so you can improve.
Okay. Now let's go on to this quantitative tightening, which is or this whole hiking cycle is hilarious, because we're now at a point where the market is priced in an entire hiking cycle, because it looks like the terminal rate is being achieved a year and a bit out, and we are still finishing quantitative easing. First of all, do you think or were you surprised at the speed upon which the market is priced in the hiking cycle?
No. So PCE is 5%, and rates are at 0, and we're buying assets. That's strange, right?
Right.
That's
okay.
not what you're supposed to be doing. What I do find surprising, though, is the terminal rate seems very low.
Oh yeah. What do you think's happening
so
there? Explain, like, well, why don't you tell people what the terminal rate is? And
yeah, so basically when they think they had the maximum rate we'll get to in the hiking cycle.
Right.
So all the repricing has been pulling forward rate hikes to this year, but the market seems convinced that the Fed basically won't hike more than, let's say, 2.25 or 2.5. And that seems strange to me because, well, inflation is high. So if you think of inflation as being fiscal driven, as I do, then you're looking at what the government is doing. So we have $1 trillion deficit, not just this year, but for basically the foreseeable 10 years, based on stuff that's on the books. Maybe it goes higher if we have more new fiscal spending. So you have that factor. And you also have what appears to be persistent supply disruptions from a zero COVID policy in many of the places where will be import goods. So, that seems like inflation will be persistent. And so that seems like it would justify a slightly higher terminal rate than let's say 2.25%. So I think that's strange, and maybe it's mispriced.
Can I give you my theory of why that's occurring?
Yes, I'd like to hear that.
So my theory of why it's occurring is because over the last 40 years, we've had more and more debt being piled on as the result of our reliance on monetarism to tune the economy. And as you rightfully point out, though, what's happened this time is that we've had a fiscal response. And because in the previous 40 years, we put more and more debt onto the private sector's balance sheets each time, it took less of a rise in interest rates for the economy to roll over because they were more indebted. Each time we went into every single recovery was with more debt than we had at the previous recovery. I think that what's different this time is that the private sector balance sheet is vastly improved. And I am completely with you. I think that the terminal rate is at least 100 basis points too low, and it could be 200 basis points too low. And the thing is, because as I suspect you are of the same mindset, that private sector balance sheets are much different than sovereign balance sheets. Sovereign balance sheets are not, financially constrained. They're only real resource constrained. And they all think that they're just looking at the total amount of debt, saying that the total amount of debt is gone up since the last recession. But I think that the composition of that debt means a lot.
100%. 100%. I mean, sovereign debt, it's not debt. It's money. Treasuries are, I think of treasuries as a form of money. So to say that the sovereign debt is a lot, that doesn't mean anything because, it basically can just be paid off by just printing more money.
Right.
The private sector balance sheet, very strong. Just net worth is super high. And so from my perspective, and because I like to look at the world through the lens of money, if you have to look at what the banking system is doing. And if you hear the conference calls from Bank of America or JP Morgan, they're saying that there's demand for credit. They're making more loans. They're creating more money. Bank of America looks at their data and they say, I'm looking through my checking accounts of my clients. People have more money in their checking accounts, even the poorer ones. So that's if you have more money, that's a purchasing power, that's more demand. So I think that can fuel more inflation. One thing that I would note, though, is just another way that I like looking at what rate hikes and so forth do, is you can also think of rate hikes as imposing haircuts on fixed income assets. So that's really mechanically what happens, right? You hike rates, fixed income assets sell off. If you own bonds, you have less wealth. If you own corporate debt, you have less wealth. So you can think of rate hikes as kind of hurting the net worth of people as well. So mechanically, just through the financial system. So that might have an impact as well as we go, if we do have reprice higher. But the thing is, those losses that it imposes, they're unevenly distributed throughout the financial system. They could fall upon people who are highly levered, which in turn will force them to sell equities and so forth. So that's a potential for an accident to happen. And maybe that's what happened in 2018.
Right.
When we tried to go beyond, let's say, 2.5.
Okay, so let's talk a little bit about the 2018 and you're doing the quantitative tightening, you're going along, and all of a sudden we get the new chair comes, Chair Powell, he's we're a long way from neutral. And then all of a sudden,
I bet he wished he didn't say that.
he was a lot past neutral. He didn't realize it already. He's not very good driving the stick shift. So I was wondering, did that sneak up on you? Like, was the Fed surprised at how quickly that the conditions soured there?
The Fed was very surprised, and they didn't understand what was happening, and I think they were very worried. And so that huge pivot that Powell did in January, it's not something the Fed commonly does, right? The Fed doesn't like to just do this huge 180, go from, let's say, saying that they would hike a couple times from the December dot plot, and then just coming doing a U-turn and start cutting in 2019. So that caught them off pretty off guard.
Okay. Now let's talk about this quantitative tightening that we're about to go on. One of the things that I've noted is that because we've had this huge reverse repo, which is, the numbers are just staggering, like 1.6 trillion or something like that. It seems to me that the quantitative tightening is not as important until that reverse repo gets chiseled down. Am I wrong in that analysis?
I think that's what President Bostic thinks when he goes around telling everyone we're going to do at least 100 billion in QT a month. I don't think of it that way. So the reason being just how the pipes in the financial system work. So that $1.6 trillion in the money market fund, in the reverse repo facility, it's held by money market funds.
Okay.
And money market funds can only buy certain assets, short-dated assets. So a lot of how this QT plays out is going to depend upon the issuance decisions of the U.S. Treasury.
Okay.
Now, in the coming days, the U.S. Treasury is going to do their quarterly refunding announcement, and they're going to tell people what they're going to issue, what type of debt. So if they issue a lot of bills, which money market funds can purchase, then that money is just going to go out of the RRP and disappear out of the RRP, and it's going to be painless. You won't even notice it, and it will play out exactly like you imagine. It won't be a big deal.
Right.
The thing is, I don't think that's what they'll do. So
your argument is that the composition of how the QE or QT occurs could create almost a problem in terms of who buys and who sells. If we did, let's say, a QT of 1.6 trillion of assets that those money market funds needed, that would be a neutral and be a wash.
Absolutely.
And so the problem is that chances are we're not going to do a quantitative tightening that's going to be easily substitutable into the reverse repo.
Yes, that's my perception. So a couple reasons for this. I mean, if you're the Fed, assuming you're doing QT because you want to make sure the housing prices don't go up 20% every year for forever, you actually want longer dated rates to go higher a bit, right? So you don't really want your QT to be completely neutralized.
Okay.
From the Treasury's perspective, Treasury has a mandate. Well, not a mandate, but a recommendation to have outstanding debt between 15 and 20% be comprised of bills. So right now they're, let's say, 16%. So, they're just by that guideline itself, logically concludes that most of their issuance is going to be in coupons. So stuff that longer dated treasuries that money funds cannot buy. So that's just mechanically based upon their guidelines. And I suspect that they probably don't really care enough to actually work this through.
Really? And so now, would you argue, therefore, that there's a good chance we get a steepener from that then? Or do you think?
Yes, I do.
Oh,
I do think we have a steepener, and I think that we have some chance of, let's say, the longer dated markets blowing up the same way that the repo markets blew up.
Really?
In 2019.
Well,
that's actually my view from the plumbing of what could be a black swan.
That's fascinating. Okay, listen, Joseph, this is so much fun, and I have so many more things I want to ask, but I'm gonna go a little long because I want to ask one more. Because it seems to be that you and I are on the same page about fiscal, monetary policy, the way that the system works, and you understand it a lot better than me. But I've always wondered this next question. Let's just use the Bank of Japan because I like using that one a little bit. Let's imagine that. So the Bank of Japan owns 125% of GDP as JGBs. And the Japanese Treasury has issued 250% of GDP as treasuries. First of all, this is my little thought experiment that I love to do all the time. First of all, if in the middle of the night they just went and took one side and flattened it versus the other and didn't tell anyone, in the real economy, would anything change?
Flatten what?
Meaning, like, you have a long at the Bank of Japan, and you have a short there, and they just say, no, we're just going to flatten those two. And they don't tell anyone.
So I get it. So basically, and this is how I agree with you, and this is how I perceive permanently rolling over QE as well, right? If you permanently roll over QE, you essentially cancel the debt, because let's say the Treasury goes and it repays that money, repays that bond held by the Fed. The Fed takes that money and just goes and buys in the next Treasury, right? So basically, it's canceled. It's debt jubilee. It's annulled.
Right.
So
it almost like, let's face it, we're gonna do that. But then everyone says, but wait, if you can do that, that means you can spend as much as you want. At which point we always go back to the MMT tenet that, yes, you were never financially constrained. You were always real resource constrained. Do you buy that, or do you? Well, I would love to hear what your pushback is about MMT.
Well, the MMT people, I mean, so the MMT works if you are, depends on who you are. Right. You can be Argentina or Brazil and be MMT, right? Then your currency would kind of implode instantly. You can. Well, the U.S. is kind of doing MMT style fiscal spending right now. If you're an MMT person, I think what you would say is that the real constraint is real resources, which is exemplified by inflation, right? So at this point, if the MMT people were honest, I think they would say, yeah, we're hitting our resource constraint for this given set of resources. I think what they're saying is, we should just go increase our resources somehow. So
listen now, Joseph, I'm 100% with you. I agree with you. People say this proves a failure of MMT. And I say, no, in fact, it actually proves MMT, because let's remember back to COVID. Everyone told us that the Carmen Reinhart and Rogoff book, that this time is different. We were going to have a financial crisis. We had just the opposite of a financial crisis. We had a boom. But what we're experiencing is inflation. We did too much fiscal. Right, like that's
exactly right. We're pushing it up against the real resource constraints, and so we get inflation.
You're bang on. Okay, we'll leave it there. Now we got to ask you the final 4 questions. So we'll start with your favorite investment book.
No, I like Lords of Finance a lot. It's not necessarily an investment book, but it's basically it tells the story of the people, the central bankers involved during the Great Crash in the 1930s, right? So I think it's an interesting and important way and helpful for investing, because it kind of shows just how much influence the policymakers have in setting the rules, and that they're just people with their own biases and failings as well. So being able to, I think, have a perspective as to how policy is going to be made, I think is very important to investing.
That's a great answer. Okay, let's go on to great traders or investors. And we haven't talked a lot about trading, but you did give us a little bit of a hint that you do have views there, because you're looking for a long end blow up. Or not a blow up, a potential blow up, something to watch for.
Yeah.
So you're obviously trading your own account and doing stuff more than we talked about. But are great traders or investors born or made?
I think they're born, because I think to succeed in trading and investing, I think it has to do with just the thirst to understand how things work, a curiosity, and I think resilience, because you're going to fail a lot. So that type of resilience and curiosity, I think, in my experience, that tends to be an inborn trait.
Okay, and now in terms of, we're going to ask you for a Byron Wien surprise, and maybe I've already blown it, because maybe you gave us your Byron Wien surprise, but is that your Byron Wien surprise?
Yeah, I think so. Just from what I understand from the mechanics of how QT works and just how the banking sector is positioned today. So in the past, I mentioned that banks were taking their excess cash and investing it into repo, and when they shrank that excess cash, the repo market blew up. So in the past couple of years, banks have been taking that excess cash and plowing that into treasuries and agency MBS. And so when they take that cash away through QT, and if they're doing it aggressively, what they're doing is they're taking away the marginal buyer in the securities, and at the same time, significantly increasing the supply of treasuries and agency MBS into the private sector. And I think that has potential to hit an air pocket and just, blow up like the repo market did. And, the repo market, super liquid. It's $1 trillion market. This is a lot less liquid given the size of the market.
And not only that, it's priced for like perfection in terms of, you mentioned that we're running 7% inflation, and yet the 10-year is under 2. Like it's
yeah.
So
and energy prices keep going higher, and if we're right about the terminal rate, maybe rate hike expectations will go higher as well, and that's negative for bond prices as well.
That's fascinating stuff. Okay, last question. If someone young was getting into the business, although you are young, so I don't know how much this is, what advice would you give them?
So I think, though, just from my experience working in just basically institutions, I think it's really hard for a young person to grow an institution today, simply because there are so many people who got there first, and they have the relationships, and they have, the influence to basically protect their own positions. So I think for a young person, it's important to be able to learn as much as you can when you go into these institutions, but try to build something for yourself, because first, I think that's more fulfilling. And, I think that's what you do as well, Kevin. But also there's just more opportunity, because if you want to go through these establishment or institutions, ultimately you're just going to have to be waiting for people to retire, and that's a slow process.
Okay, that's a great answer, and it segues perfectly into what you're doing for yourself. And Not only are you a terrific speaker, an entertaining guest, and a knowledgeable contributor, you also have this blog, and you have plans to expand it. So why don't you walk us through the vision of your dream of what you'd like to be doing?
Oh, thanks, Kevin. So I have a blog. It's called fedguy.com, and in it you can find a more detailed commentary of how the monetary system works and how I think the QT time bomb, as I describe it, will pan out. But my experience is there's a lot of interest in how the Fed works, how the monetary system works, and so forth. I have a book out that's selling very well, Central Banking 101. So what I'm doing now is I'm building out more of an educational platform where I have online courses to take people into more in-depth topics. Right now, what I'm working on is a more in-depth dive of how the Fed balance sheet works, the various components, what influences them, how they work together. And in the future, I will also talk about things like US dollar money markets and other topics.
That's awesome. So when do you plan on or hope to have that out?
Hopefully in a couple weeks.
Oh, it's soon. Oh, it's great. Okay.
Yeah, so just check on my website, fedguy.com, if you're interested.
Oh, that's awesome. Joseph, I've had so much fun, and honestly, I had to stop, but I could go on for another hour. I love talking about the plumbing, and you have given some of the greatest answers, explanations, and taking the time to explain what it was like there during COVID and all your knowledge. I can't thank you enough. Thank you so much for being on our show.
Thanks so much for inviting me, Kevin. I love your show, and I can't wait to watch Talking Charts tomorrow morning.
Thanks again, Joseph. Take care. All right, Patrick, time for Talking Charts. What do you have for us?
All right, let's quickly go through it. We were looking at the top 3 last week, and so from last week we were talking about the precious metals markets and crypto, what was going on there, central banks, and then what was next for equity. So let's just have a quick run through each of these. Obviously, after the Fed meeting, the precious metals took it. Oh. It was disappointing. Like, we goochered it, didn't we?
We did. And listen, we're just thinking about all of you folks out there in the value add that we have when we both agree you got to go the other way. And I don't know how many times we have to prove this, but yet again we did it. It's as I've said before, it's hard to be this wrong.
What is interesting, so precious metals simply faded right off there. The U.S. dollar strength has something to do with that. But what I want to just touch on is overall, Bitcoin has had a pretty oversold state, but it's been pretty weak on bouncing as well. And the one thing I look for when we get close to a bottom is that the bulls start getting some violent rallies going the other way and really start to solidify a bottoming formation. And there just seems to be no enthusiasm to take it off of these lows, and that makes it still vulnerable in the primary trend down. This is not the price action that the bulls really that support the bull case at all. The other thing that we were talking about was central banks. Obviously, we were talking about the FOMC. What did you take away from the meeting?
Well, it was interesting because earlier we had the Bank of Canada earlier in the day, and the Bank of Canada took a pass and surprised the market by not being that hawkish. Dollar sold, the Canadian dollar, the loonie sold off. We had backs rallying. And then we were going into the FOMC. Everything looked like it was going to be a replay of that. We had S&Ps up, 40 handles at the time? 50 handles? Yeah. I can't remember. It was up a long way. Everything was looking good. And then Powell stepped on his you-know-what again. And they just beat it. And it's... That guy is, anyways. I don't even want to go there. It's a complicated, not something that's easily explained in just one sentence.
All right. Well, so listen. Let's talk about these equities, because the number one thing was to obviously watch for the equities. Now, one of the things we were talking about, at least that I was highlighting, is that we didn't see that VIX spike last week yet that really kind of solidified something that could be a legitimately tradable bottom. But really, we started the week with one huge puke to the downside on the market. That spiked that VIX up to that 38 plus level on the upside, and the S&P 500 just had that one really ugly drop that led to quite a strong intraday reversal. Now, while we saw, for instance, the reaction in the post FOMC was the market reacted negative, the reality is that we've more or less stayed within the same trade range of that Monday's trade day. So it's not like the FOMC started a new massive trend. We've been just ping-ponging back and forth within a couple hundred S&P points, just up, down throughout these in this whipsaw. And the market really has already had capitulating levels of oversoldness. And so I'm curious whether or not we get one of those violent rallies here. And it's not that I actually think the market correction has to be over. We might very well be weak right into February or into the Fed meeting. But maybe for now, that might be enough. And then maybe some sort of like a little rip to the upside is the path of least resistance. What do you think?
Well, I think you did highlight that the VIX is finally inverted. There was definitely fear, lots of negativity. I saw that Jim Cramer even got out and said, sell Kathy's ARC. He's going to bottom tick that. Yeah. Jimmy Cramer, he bottom ticked it.
And then that's when Cuppy clearly loaded up the
no, I don't
wheelbarrow.
know. I don't know if they coincided, but no doubt, listen, it's chopping around. My best guess is that it frustrates both people, the Bulls and the Bears, in the coming weeks. And although I think we could probably grind a little higher over the short run, I suspect that the types of bull runs that we're expecting, or many people are expecting, is going to be disappointed. We've taken for granted that the stock market goes up, 30, 40% a year. And Patrick, you and I both know that's not what a typical year looks like. A lot of times it's up, 20, down 10 to finish up 15. And right. I think that we could get one of those years. And every time that I hear, if you use the past 2 years as your expectations, I think you're going to be disappointed.
Right. All right, so let's talk about the top 3 things to watch this week. And number 3, well, we have the jobs numbers coming out next week on Friday. And certainly, obviously, everyone's looking for signs in the labor markets as to whether or not there's things are kind of slowing down a little bit. You expecting anything out of those numbers?
Well, I expect all economic numbers to err on surprising to the downside for the next little while. Yeah. Patrick, I look around at this Omicron wave. If you got on and tried to actually talk to somebody on on a customer service line. Like your other partner that you cheat on me there with, he mentioned on the show that he said he tried to change a ticket and it was 4 hours or 5 hours on American Airlines or whatever he wanted to do. And I'm hearing stories like this everywhere. I think that this past month has been a big disappointment in terms of economic output, just because people were home. People had kids exposed. They had to stay home. And I think that we're going to be kind of shocked that we have a little bit of a mini slowdown in the coming months. And I don't know when those numbers start to bleed into the actual releases, but I suspect it's coming sooner rather than later. So right. I'm just looking for surprises the other way. That's the way I look at it. I think that we're going to be surprised.
So we're going to jump from 3 right to number 1, because and we don't need number 2. Number 1 is what's going on with that U.S. dollar.
Now, for everyone that's expecting me to give Patrick a hard time about this, I actually
you gave me the hall pass.
I gave him the hall pass. That's a good way of putting it. I said that we got to put it into this week, and I actually, Patrick loves to talk about it as being the linchpin of all markets and very important, but he might be right this time. It is something.
Hold on,
to watch.
Nina, record this. I want this snippet so that I could play this at certain times in the future. Right. Anyways,
it is important. We had the euro breaking to new lows. There's all sorts of worrisome signs out there. I'd watch it. I could see the dollar actually causing increased problems going forward, and it's something that you should be on your radar.
I don't know anyone that owes a thing of boxed wine to me at the in the
no,
next
I don't know
episode.
anyone like that. I don't know anyone
we'll,
like that.
We'll talk about that in there. But
here's a question for you, Patrick. I'm going to ask you a question.
Yeah.
One of the things is I look at this euro, and it's really smart that people are telling me that this thing is still a sale and that we're headed a lot lower. And people that we've that I respect tremendously, that have done this for a living, that are now retired, people that are really, really smart. And I can't bring myself to really think this is the trade of this year. It seems to many people believe.
But listen, if the euro is going to parity or some bizarre number lower than that, I don't think it's going there all in one shot. And so I think with this breakdown, it kind of blew through anything that could have been leaned on, like Fibonacci zones and other things. And all you really have on this weekly chart are the 2017 and 2020 lows, which are all in that kind of 105 to, let's say, rounded to 108 level. And so with this current breakdown, I mean, the path of least resistance is potentially for us to see, 200-300 pips at least to retest some of these lows. At least there's no guarantees, but it's certainly a short-term move that's on play. And then making the bigger call that the euro is going to go to parity or something will happen when we see how the currency responds to those levels, right? So I think we can worry about making big currency calls later in the year. At this stage, this is a short-term breakdown that probably has set in motion a trend that could potentially stay in place between now and the first rate hike in March, and maybe that rate hike in March will be a key currency turner. But maybe for the next 4+ weeks, it's going to be a lot more of the same here.
See, my problem is, Patrick, I cut my eye teeth trading stocks when they used to not trend. And I see breakdowns like that, and it just feels to me that those are just sucking in all the people that are shorting it. But I know that currencies, you almost have to stop thinking about it. They break down, you go with it. And even if it's way oversold, they trend.
Well, I
don't
see much asymmetry in starting if you're only starting to short it here at a 111. It's kind of there's not much asymmetry anymore. Shorting it when you were making me a bet of boxed wine, then that was actually a pretty good start point. But this is this is almost like a little bit of a chase. I mean, look, if it goes down to 110 here, I mean, what are you going to clip 150 pips? It's okay. I mean, it's a trade, but it's not getting me excited.
So I'm nervous about shorting it. You're telling me there's no asymmetry in shorting it. Folks, you should probably lean into this thing with everything you got.
Listen, it worked for gold last week. I mean, our members know. They know that this works. Anyway, so that was number one, but we might as well have a number two that we can mention. Number two was OPEC. And we're going to have a little bit...
OPEC spelt wrong, but yes, okay. That's just your desire to always have OPEX in there.
That is
okay. So we
That's
do.
funny.
So we have to talk about OPEC because there is a meeting. I'd love to hear what you think up here. First of all, it did not prairie dog like you thought it was going to prairie dog, and that again.
Wait, what prairie dog was I talking about?
You were talking about this as potentially being a prairie dog.
No, sorry. On
last
this,
show.
Yes.
So, which, by the way, I'm going to make. I've already got the chart set up. I'm going to send it to Lena, and we're going to make a Twitter poll. And I've already decided what.
Oh, so this is a democracy where people get to decide what this pattern is.
Yes, for sure. And we're going to put your crude oil.
Oh my God!
Against the true prairie dog textbook formation, which
textbook. Okay, tell me which
textbook.
Which textbook is this?
In the Market Huddle textbook. It's the IWM.
You say it with such authority, like you're like
it really exists.
Oh my God, like unbelievable. Okay. All right,
anyways,
listen,
let's talk about crude oil.
Can I not make Mike? If you're going to do this, I feel it's my obligation to make a case for my chart. So maybe what we both have to do is make a case and then let the polling.
Well,
happen.
you know what we'll do.
Because you have a very clear bias. You're going to slant your tweet to your.
No,
Twitter.
we're going to let Lena do it. Lena, no. I don't think you should be allowed to say anything. You shouldn't be allowed to argue your point. We should just put the charts should speak for themselves. We put the IWM against the crude oil. Lena tweets it out with no bias, and we see let the chips fall. But let's talk about oil because I'm getting nervous about it. And I don't know why. I know there's all these reasons to be bullish, and I know all of the long-term positives and stuff, but I don't know why, Patrick. It scares me. And tell me I'm being foolish.
I don't want to gooch or anything. Maybe I should just say shut up.
Oh, okay. I didn't realize
but look, I mean, right now it continuously is making higher highs and higher lows, which is means that a punch to 90 going into OPEC is entirely possible. But back to the word I used earlier, like after of asymmetry, like after a $20+ move to the upside in the span of a month and change, this thing has gotten overdone on the upside. More importantly, the backwardation is just getting steeper. Everyone's leaning into things like that there's some sort of something at Cushing going on with shortages and all this stuff. And at some point, we're gonna that huge steepening in that backwardation is gonna just come out of it, and it's gonna come back to normal.
Are the barrel eyes talking about problems at Cushing?
I've heard a few.
Okay. What is your other
No, he was the one talking about it. That's
he wasn't.
The barrel eyes. He is the barrel eyes.
Oh, he is the barrel eyes. Okay. Okay. Well, there you go.
But no. But I mean, he himself is not convinced that he's just talking about it because that's what
other barrel eyes are talking about.
Yeah, exactly. But the way I look at it is that at some point, there's going to be a point where they're going to wipe $10 on the downside. Like, it's no different than what happened in November when we had this wipe. But this wipe wasn't a fundamentally driven drop in oil back over here. This was a liquidity event because everyone was long and leveraged to the tilt, and then they got washed out. Margin called and just cleaned. And at some point, the market just does that over and over again. And if everyone gets crowded in the long side of the oil trade, it's going to do the same thing again, right?
Okay, well, we better not say anymore. We don't want to go.
Okay. All right. Well, listen, I'm not short oil, so that I'm taking a neutral stance where I'm lightening up on long positions.
Okay.
All right. So the that's what our top three. So let's talk charts. Let's go through some of this different stuff. What I want to do is let's actually do something a little different. Let's actually hit up some of the currency markets first, and let's just look at some of these different currencies are doing. What I wanted to first actually start off with is looking at the Japanese yen. And for a while, up until the FOMC, it wasn't participating at all. And it really did kick up higher in the last couple trading sessions. And it'll be interesting to see whether or not we see the US dollar break out here to confirm that euro move. Because even another big cross.
Whoa, 1 second. Go back to before you talk about that. I'm so proud of you.
Why?
Because you put like the proper way of quoting yen. You're like a grown up now. I feel like remember in Goodfellas when he gets arrested and he doesn't snitch on anyone, and then all the mobs there waiting for him when he comes out of jail. I feel like we should do one of those for you.
I did it for you, man. You know, I like to normalize everything so that I'm looking at it as
I know you do.
Currencies crossed against the dollar. It just organizes in my brain that way.
Listen, I completely agree with you that it's kind of ridiculous that they have different ways of doing it, but it's still funny razzing you about it.
Oh yeah, that's fine. You can do that. But what is interesting is that when we go to the pound, the pound sterling is not broken yet either. So the euro is kind of running on its own when it comes to the three big boys. Even the CAD is not broken to a lower low yet, but all of them are generally trending that way. What really has been the theme in the last week has been the U.S. dollar has legitimately been moving against all cross currencies. It's just not all of them have broken major support levels, right? And so it'll be interesting to see whether, like the U.S. dollar CAD, we'll look at it that way before you bust my balls again. But what is interesting is looking at ones like the Aussie, right? And like you look at the Aussie dollar really has rolled.
That's looking ugly.
Yeah, like it's like ready to go. It's like as ugly as the euro, right? On the downside, and so interesting seeing some of these charts. Even look at the way that the Kiwi's been getting slammed.
Wow.
Like this is an ugly chart. Like they've literally, not only did it break to a lower low back in December, shitty consolidation and a fresh breakdown, just getting hammered, right? Like it's certainly one to watch. Another thing, you gotta. Argentinian peso. You know, this is the easiest technical chart to trade.
But the trouble about this is it's bullshit because you got to look at the carry on it.
Yeah,
right?
No, but it's just like it's just such a funny chart to look at. That's all.
Yeah, it is funny. Because Alex Gurvich, he talked about that with the Turkey, the lira. The fact is, everyone trades the currency and they look at the nominal price and they don't actually look at the total return. And the total return chart is actually it slopes the entire different way.
Yeah.
Anyways,
well, I mean, it makes sense. It makes sense. The other thing I wanted to highlight, like obviously the Russian ruble has been getting hammered quite a bit as well. Obviously, some geopolitics in play there.
Do you think the bottom's in? Like, do you think that you can bottom fish on that one? Like, just put away the politics. Like, just look at the chart.
But let me put the politics in. Okay. I honestly think that this is just the story is being worked up, and the chances of a de-escalation are much greater than of there being a further escalation. Okay. At least, look, anything can happen. I'm not an expert on the thing.
No, but you're just calling what you believe. What's priced in is too high versus what they actual.
Yeah, and if there's a de-escalation, like we could look at the Russian stock market, which has also been hammered, but the ruble's been hammered, and the fact is that they are massively benefiting from high energy prices. Like as soon as the geopolitics come out, why wouldn't these things have big snapbacks the other way? I mean, I'm curious. this is probably where it's worth paying up to buy gamma. Like don't play this straight up playing the long currency or long their stock market. I know like the Russian equity market had like a 30 handle on their on the vol premium, but it's probably worth it.
30 is not that bad.
Yeah, like why would you take all the downside risk if there was, like, even if it was a 10 or 20% chance of a major escalation? Like the thing is that, do you really want to be the bag holder if it did? Like, you might as well buy some options, and if they get zero, you know what your loss is in advance, right?
The Citadel sending you the check.
Yeah, exactly.
Buy options. Sponsored by Citadel. Okay, let's go on.
I wanted to touch on that South African rand, which is also slightly rolling over. But anyway, so interesting charts that are developing in there. Even so what was the other one? Let's look at now Mexican pesos is not that. I mean, it's just trade range bound. I think that's enough for that. But let's go on to. I wanted to just touch on some of the commodities we don't normally talk about. By the way, the grains continue to look half decent. Okay, I'm not going to talk about them. We're just
you can talk about them. Just don't tell me you're long. That's all.
I'm. Okay.
Don't tell me.
Okay. I'm not going to say anything. But while wheat is kind of hasn't taken off, but what is interesting is corn and both soybean have both really just been following through. They've been working. Even that rice contract is edging higher. So it's definitely a market that's been working here. What is interesting is as well, copper just is behaving like gold. Like to be honest, if you didn't tell me that this was the copper chart and didn't see the numbers, I would tell you that this looks like the gold chart.
Yeah,
right? Like just like completely got it's
higher real rates will do that to you. Yeah. I'd love to see a washout in this so I can buy it. Yeah, I'd love to see some pain and some selling in there so I can buy it. I gave up on it. Which probably means it's all clear. It's going to be good.
But interesting, cotton continues to.
Oh, look at that chart. See, we should just close our eyes and buy anything like any commodity that starts to behave well.
Yeah.
The less you know about the fundamentals, the better you are. Just buy commodities that do well. It's going to be like Richard Dennis when he used to do his trend following back in the 70s and the commodities. What's that one?
That's orange juice.
I still have never traded orange juice. Have you ever traded orange juice?
I have not.
I got to go and buy.
I did do it with actually a CFD contract. I just never done it with the real
ones, like the Eddie Murphy ones, Dan Aykroyd ones.
Yeah.
You got to do it. You got to do the real ones.
Listen, how the hell can we run a podcast without doing that? I'm just gonna literally go put on an OJ contract.
Well, why don't we come up with
after?
No.
Let's
pick a chart level. Let's pick a chart level where we're going to buy this thing. What's happened today?
I'd wait for a retrace to 140.
Where the hell is Beaks? Because look at this big red line. Okay, 140.
There you go.
That's too low. It's not going to 140. Yeah. You think?
Well, I'm just saying that would be a great buy on it. Like if it got down to 140, that's where I'd love to.
I'm going to buy it ahead of you. Maybe I'm going to front run you. I'm going to buy it ahead of you. Okay, go on to the next one.
Yeah, which basically means once we both are long, though, that everyone else keeps going short.
Yeah, it's just gonna keep.
And we just have to just touch on block cheese futures. Just to they've been slowly recovering. I don't even know how to trade block cheese. Has
anyone ever we got to find someone that's actually traded some block cheese and isn't from Wisconsin.
You know what? Anyway, let's wrap up the talking charts with some global equities and just take a look at what's going on now. What is interesting here is when you look at the Argentinian stock market, it does look very bullish when your currency is eating it. This is literally Cuppy's Project Zimbabwe thesis, right?
That's right.
You should change it to
Project Argentina.
Yeah, absolutely, because it's the real-time version of it, right?
Yeah,
So, like,
exactly.
if you notice here, it's off of its COVID lows. It's up 345%. So, if you just pretend that you're not eating it with the currency, you're actually making a lot of money in the stock market. But like, is it that simple? You just you go short the currency against long their equities. I can't be that easy. There's got to be that's already got to be baked in. Is it that simple as a carry of a trade? I don't know.
Well,
Anyway,
I don't know how you. No, because there's a carry built into the currency as well.
yeah, exactly. And so it's not that easy, but boy, is that market done half decent. What is interesting is there are a number of people out there starting to ask the question whether Brazil has bottomed.
Is there someone
And,
who runs his own group and talks about trading with different members?
Yeah, there might be some.
Good news is I haven't bought any, so you guys are okay.
Yeah. But it'll be interesting to see whether or not, like, you know what, obviously, like some of the big players in there, like the Vale and the Petrobras and all these other ones are all in the right sector. So you got to think that this market has got to have room to turn around at some point. But here we go. This is the the Moscow exchange, the Russian index here. And yeah, that obviously has been just eating it on the downside. But I'm curious whether that will be a low. Like it seemed like just a couple weeks ago we had that huge puke to the downside. It'll be interesting to see whether or not that bottom sticks in the coming weeks. It might be just an interesting one, like we were talking about. Just buy some call options on it and plug to Citadel, right?
Okay, so what's
India is it like I would a week ago I was just so impressed how they were holding this higher, and obviously it got caught up in this shit show and dragged down with everything, but it still hasn't broken that previous low. It'll be interesting to see if the market's calmed down here, whether it can make it back above 60,000 and start kind of getting off this danger zone area. On there. What's interesting, I want to talk about some of the Asian markets. So here's Singapore. It's been an ugly couple months in this index, right? But look at the way Kospi has just been murdered.
Oh my goodness.
The South Korean
Jesus
index
Christ.
ate it.
I had no idea.
Yeah, like it was a free fall just this past week. At some point, this is a no-brainer to scoop some of this up. But then, but the Asian markets have just been so weak. Like here's your Shanghai. Look at the way the Shanghai index has just gotten murdered in the last month, right back to the bottom of its range. The China A50, right back down to those lows. Just a complete fake out.
Do you think that this is their attempt to do the zero COVID policy, and they just it's crushing the economies?
I don't know, but even the Nikkei broke in that 1 year trade range to the downside. Like the Asian markets, I think it was one of the few markets, like it was the Philippines market, or I hope I'm not screwing that, but there was like one or two Asian markets that were holding up, but like the majority of Asian markets are eating it.
Oh, they're terrible. I had no idea. This is the good thing about talking charts.
But like what's interesting is that and this is the weird part, is like we focus on the Fed and the S&P 500, and we talk about whether the FANGs are going to drag it down and stuff. But when you look at the global equity complex, these charts are brutal everywhere. Like there's a global equity sell-off underway, and there's very few markets that have been resilient.
China and Asia is way worse than I ever imagined.
They are, but okay. So one of the markets that held up half decently, it's still kind of had a bad couple of weeks, but the Euro stock has been generally holding up, right? And so some of these European markets are holding in there, but Australia had a really bad week. It broke almost a 6-7 month trade range to the downside with a heavy break. So yeah, it's there's a lot of these markets around the world that are very, very weak.
More pain under the covers than we thought.
Yeah. Anyway, I think that's enough for talking charts, but that's all I got, Kev.
That's great. All right.
Skin in the game, buddy.
Okay, so we took a week off and I lost, right? Like this is
well,
from
the
2 weeks
week
ago.
before we were going to settle it.
So why don't you tell people what I foolishly did, and then we'll go over.
Well, it's not foolish, but I think your foolish thing was you were confident enough to up it to wine.
Oh, yeah.
Like, yeah, you could have kept it to a pitcher and not sting so much. But and now then again, the boxed wine isn't that expensive, is it?
The boxed wine. Cuppy insists it's better in the
Azores. So yeah, he was.
The bet was
the bottom line is that he goes quantity over quality, which is a good virtue.
I'm sure he's going to be very excited to hear that. Okay, so there was euro dollar to close over or under 114.14, and I lost that. Okay, so why don't we tell people what Skin in the Game is? It's a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows: a Duke and Duke, a pint of beer, a burger bet, a pitcher, a case of beer, affectionately known as a 2-4, bottle of wine with a $100 limit, and the big daddy of them all, they steak a dinner. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions. Okay, so what do you got for me?
Well, let's place a bet on this nat gas contract.
Oh, that's a good one. What's the guy's name?
Now, first of all,
what's optionsellers.com's name?
Oh my God!
Oh
my God! Morris talks about him all the time,
I know,
and now it's eluding me.
Yeah.
Oh no! Like we knew his name, we would say it all the time. Oh my God! Well, anyway, we'll have to look it up. But anyway, the point is, there's been all sorts of crazy things happening. Obviously, there's a big, winter front or whatever coming through the northeast, and it's caused some of this. This is the April contract, but when you're looking at all of them, they've been all starting to move, and. Well, you know what? I like it when something moves like this because you tend to, like it almost feels like a prairie dog, Kevin.
Oh, you're really tempting me. By the way, James Cordier,
thank you.
Yeah.
So, I want to bet on whether this is a prairie dog. This is the April.
That's a great bet. Okay, so this is April?
This is the Henry Hub April the 2022 NYMEX contract, and it's right now. Like, so the thing is that how do we define the prairie dog? Does it have to be below, let's say, today's candle? It's like, let's say it has to
go back into the range. So what is the top?
Which is below.
What's the top of that other range there? Like, draw that line, and that's
okay.
where.
Let's call it 430.
Okay.
430.
I'll take above. I'll take above.
You'll take above. Okay. Then I guess I'm playing that's a prairie dog. All right.
Yeah.
All right.
I sure as hell hope it's not a prairie dog. That's awesome, though. That's a great bet. Okay. What do you want to do? What do you want to do?
Well, no, you're the one. I made the bet. You're the one who starts the bidding.
Oh, okay. Shit. I don't want to be too excited about it because you know me, I'm always along the whole, nat gas strip. So
you just lost a bottle of wine. So
I can't go. I'm going to do a pitcher. Pitcher it is.
Come on, you could do better than that.
Oh, I'm not going to. That's not a good way to go about trying to get me to go more. I'm going to go lower if you keep going that up. Pitcher.
All right, pitcher it is. All right. So it's the April nat gas 430. We'll use as the threshold. Is it a prairie dog? Love it.
Remember the James Cordier, though, with the option sellers? Remember we figured it out, and the funniest part of the story was that he actually could have got out?
I didn't know that part.
Yeah, remember we went and figured out the math about like how much it moved, and then we went through it, and we figured that to zero his account,
because he had to be 3x on the whole account or something.
Yeah, there
ridiculous.
was something we went through the math, and we said, "Oh God, this guy's an idiot," because he had lots of chances to get out. It wasn't like an overnight move that crushed him. It was a series of overnight moves that he just refused to. He did the old deer in the headlights thing. But that guy, he just cracks me up with his fancy watch. Like, leave the fancy watch at home when you're making the impassioned plea about losing all your investors' money. Have a little dignity. Okay, Let's get Lena on and get the show up and
Yeah. So let's do some no stupid questions. Lena, what do you got for us?
So first question here. Hi from India. I have a question regarding the yield curve. The U.S. 2-year yield has been rising sharply since early December 2021, but the 10-year has not risen that sharply, leading to flattening of the curve. Can you tell what to make out of this, given the macro environment and the looming Fed's announcements of pulling off the taper and gradually increasing rates over 2022? Thanks again for the great show.
Okay, I'll take this one. This is right up my alley. A flattening of the curve generally means that the market is expecting less economic activity or less inflation going forward. So it's the Fed is getting hawkish, and they're assuming that as the Fed raises rates, that will snuff off growth and or inflation and cause the economy to roll back over. If they thought that the Fed wasn't getting hawkish enough, they would go the other way. They would actually steepen the yield curve, because if you think about it as a long-term fixed income investor, what's the worst thing that can happen to you? The worst thing that can happen to you is inflation. So future inflation is actually one of the biggest worries that you have. So you sell off when you think there's going to be more inflation, you sell the long end, you buy the short end. When you think that the inflation is going to go down, you buy sell the short end, you buy the long end. And that's in essence what's happening. Hope that answers the question.
All right. Let's go to the next one.
So second question here. Thank you for using the Market Huddle to introduce new topics to your listeners. For example, last week's idea to be long euro volatility. Would buying a strangle on futures be an effective way to express that trade? With the euro at 114, maybe the December 2022 115 call 113 put, or 116 call 112 put with an implied volatility of 6%. How could one manage the cost of the time decay? Thank you.
Well, Kev, I'm going to let you throw in your hat here, but when you're putting on these kind of strangles or straddles, that's the biggest obstacle is you're betting on long volatility, but you're eating the theta and the carry, and you're hoping that you're going to get some sort of a meaningful move on these things before the theta gets you, right?
Right. And so there's a couple of issues that we have here. One is, let's imagine that either one of these, it doesn't really matter because they're not that far. But let's say that the euro's at 114. Let's say that you just buy the option and let it expire. You buy the strangle and you let it expire in how many months is that? December, a year from now, right?
Yeah.
So a year from now, you buy the option, you let it expire a year from now. If you were to have a situation where the euro went to 120, down to 100, and then back to 114, your options would have expired worthless. So you would lose, even though volatility was actually quite high. I'm assuming, I don't know. So the way that market makers deal with that is that they actually, what's known as delta hedge. So to properly make an expression about whether of future volatility, you would delta hedge to make the chances of your position reflect the actual underlying volatility that you experienced during that period. Now, it's a little more complicated than that, because let's imagine that you delta hedged and it immediately went to 80. Well, what would happen is you would buy as it went down because your put would become more in the money, but you would relatively quickly get to a point where all your gamma is gone, meaning that the delta on the put is 100 or minus 100. And therefore, as it moved around, you didn't benefit from the increased volatility. So theoretically, that's why Jim Leitner does a swap that is based upon the actual volatility of the underlying. So if you wanted to recreate that, you would do a series of calls and puts so that you would never, hopefully, move that far away from the strike. And the trouble about that is it's very difficult. It's tough to do. But I know when I, for example, have a view that I want to express, and I don't want to lose my bend. what I will do is, like, let's take the yen. Right now, I bought some calls on the yen to for a variety of reasons. But one of the things that I did was I didn't just buy, let's just say, the 2% out of the money call. I bought some of those. I bought some of the 5% of the money calls. I bought some of the 10% and some 15s so that I will benefit from bend as it moves through different strikes. Does that explain it, Patrick? Do you have any?
Yeah, no. Well, I mean, I tend to try not to make my trading get that complex. Like I tend to be a directional trader, so I love the fact that the volatility was cheap for putting on directional currency bets as opposed to just betting on volatility expanding. So I typically don't put on trades like this, but I get what you're saying.
Right. And Patrick's much better at letting it run than me. My trouble is that I have trouble. Like when an option goes, and let's say I buy an option with a 30 delta, and then it goes to 100 delta, I have trouble because in essence I don't like the fact that my delta has increased so much. So I like trimming it back and keeping my delta the same. Anyways, let's go on to the next question.
So last question for this week. Hi, Lena, Patrick, and Kevin. Love the show. I recently started trading in equity options, specifically buying call options in the energy space. So far, I have fared quite well as investors seem to be rotating back into energy. I'm a big believer in resilient demand for fossil fuels and that investment in supply is far too low, which leads me to remain bullish on energy names over the medium term. That said, there generally isn't an options market on the quote-unquote shitco's with the highest leverage, and I struggle with how to account for dividends being paid out by energy companies in valuing options. Obviously, dividends being paid out to holders of the underlying equities don't accrue to holders of call options until you exercise. But am I right in thinking that option pricing in the market should account dividends that the market is expecting over the duration of the option period? Am I crazy to be buying longer dated call options where the dividend yield on the underlying is pretty significant, up to 10%? Related, but maybe too complicated, if I hold call options on a company who significantly bumps their dividend or the horror declares a special dividend, am I silly to think about exercising early and give up the optionality remaining to expiry? What is the best way to think about this?
Do you want to go, Patrick?
No, well, I was just going to say that right inside the option pricing model is the dividend discounting mechanism. So the call options become cheaper and put options more expensive. The larger the dividend, it's already being discounted is to one degree or another. It really, though, is interesting how they adjust for special dividends, right?
Well, yes. Special dividends can, if they're large enough, they adjust the strikes. Right? Am I correct? You probably know better than me.
They do. No, they do, exactly. So what happens is that they will literally change the deliverable where you have to deliver the shares and the dividend on delivery, right? So or they'll change the strikes is another alternative, right? But there are different ways they settle those options, but rarely do they just not account for them.
But you are also correct that the dividends are built into the model, but the thing that you always need to remember is that those are forecasted dividends, and they're just people like you and I, Patrick, making a guess about what it's going to be. And there's times that they're either mispriced or not, or cheap or dear compared to what actually might happen with it. Now, most of the times on shorter dated options, it's almost irrelevant. Market's efficient, it doesn't matter. But when you get into longer dated like leaps, or I had a situation, Patrick, where I learned this the hard way. I was trading some long dated warrants in something, and they changed the dividend out of the blue. And then all of a sudden my warrant got priced differently. And I was like, holy shit, I lost a lot of money there. And I was flabbergasted how much risk I had to this. So one of the keys is as you get longer dated, it means more and more. And so therefore,
that's where like an example, when like now we're talking dividends, but when you talk about interest rates and negative interest rates, like Harley Bassman and you have traded the euro long dated options on the Euro stocks and stuff. Exactly, because of that discounting mechanism and the impact it has. The point is that the options market is very efficient, and almost all of these things are to one degree or another, they attempt to be properly priced. Whether you speculate that it's not properly priced is where arbitrage comes in, right?
Yeah, almost always you should just assume it's properly,
it's efficient.
Yeah. The only other one final comment that I have is he mentioned shitcos, and I always joke with Cuppy. I always tell him that there's companies that he trade often have so much debt and are so shitty that they are call options in themselves. And that is something you need to think about, is the more operating leverage and the more debt that is on a company, the more it's going to behave like a call option.
Right.
Right. And so that's why generally those smaller companies with higher cost base of the resource or whatever trade more with more volatility. Anyways.
Bang on. All right, Lena, where can they submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right. Thanks.
Fantastic.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. Lena's there. She's making good jokes. Her Twitter game is out of this world. You want to make sure you go and give her a shout. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our latest charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate us, review us on iTunes. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, or follow me at bigpicturetrading.com. Kevin, where can they follow you in that fantastic newsletter?
At Kevin Muir on Twitter, or you can check out my letter at themacrotours.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. All right.
We got to rate this beer.
Okay, so first of all,
first admission, I didn't finish the can yet. Like I'm.
You're having trouble. It's
drunk.
A little bit of a.
I'm not drunk, and
it's a little bit of a puckering, like.
Yeah, it's like a lingering puckering sensation.
Normally, I have no problem. But we've had sour beers before, and I'm not saying this is a bad thing. I'm just surprised I'm not done.
Yeah. So we have to talk a little bit about the fact that Winnipeg is the Slurpee capital of the world for the 22nd year in a row.
How do they even measure that? Like sales of Slurpees?
I guess so. Let's have a look at Access Winnipeg here. And you would think it's the craziest place for it to be a Slurpee capital, but because it's cold, right? And so
for them, it's probably like, oh, this is nice and warm. This is going to warm me up.
Yeah, so let's just see here how they determine who is the Slurpee capital of the world. Okay, sorry. Slurpee is the #1 beverage served to women in Winnipeg's maternity wards.
Oh, interesting.
Nice. Instead of giving flowers, people meet and greet their friends and family at the airport by giving them Slurpees.
Interesting.
No way.
For sure. You don't do that? When it's minus 40 degrees outside, people are seen waiting for the bus, biking and skating with a Slurpee in hand. Now, for those who don't know, there is the greatest video of a fellow in rollerblades in Winnipeg on Henderson Highway in the pouring snow, like snow piling down. He's wearing a sombrero.
Slush snow. It's
he's wearing a sombrero.
Gross slushy snow.
And he's drinking a Slurpee, and the Canadian Tire truck goes by. Like, there's just nothing more Canadian than that.
If you don't know what we're talking about, we tweeted about this earlier.
That's right.
So go follow
Slurpee
us
is
on
often
Twitter.
served at summer weddings. People consume Slurpee drinks for breakfast year-round.
As breakfast?
For breakfast.
Yeah.
Oh, jeez.
Does it come with a Red Bull Slurpee?
Oh.
Okay.
That's terrible.
Okay, so yeah, that's it. So, anyways, that Slurpee is very important.
What a better way to get your beer some exposure in Winnipeg than to call it a Slurpee?
Yeah. And, Paul was very kind. He's a very super nice guy. He gave us these. I dropped by the way. I was picking them up on my way when I was driving through with my RV. And I thought he was going to live on a side street, but it was actually a pretty busy street, and I couldn't stop. And it was it was like a shit show. And the car was the RV was doing something funny, and it was like I was worried it was going to break, and there was some weird light going off, and I sent my daughter and. Like I said, I'm like, go pick it up, and they're like, and he's like, and Paul's like, you're Kevin's daughter, and he's yeah, and he gave us these beers. So big thanks to Paul for passing them out. And he was worried they were going to go bad. He's a real beer connoisseur. Oh. He was very concerned that we hadn't drunk them fast enough, and they might go skunky. Not that we could tell.
No, actually, no. I can tell skunky beer, and
you'll still drink it anyways.
No, this has not gone skunky. I'm trying to evaluate the taste profile, but it's not gone skunky.
So, okay, so let's get to it. I'm going to go last as the home court Winnipegger. Lena or Patrick, who wants to go first?
I can go first.
Okay.
Go for it.
I found this, the first sip was very, very tart, and it made me literally pucker up. But it's got like an addictive sort of quality to it. The more I drink, the more I want to drink of it, if that makes sense.
It sounds like a Slurpee.
Yeah, like I would probably pop this rest of this in the freezer for a few minutes and then have it actually slushy. I'd give this an 8.8.
Nice.
I actually really like this beer.
Yeah. Okay.
Yeah, it's really
there we
good.
go. Okay, Patrick, you go ahead.
Well, I can't go that high. I'm sorry, guys. I'm. You know what? We've had many sours on this podcast, and I'm trying to actually rate it against other sours that I've tasted. You know what? I'm gonna give it a 7.2.
Oh.
And you know what? It's a good beer. I'm not gonna shit on it, but you know what? I feel, you know what? Like when you drink Coca-Cola or something, you get that kind of fuzzy feeling on your teeth. It's like. I'm getting that. It's like it's not my type of. I don't know. No, I'm not. Sorry, 7.2. Yeah, I'm done. I'm done. I'm not going to say anything else.
Okay,
it's your turn.
So, you know me. I don't usually like sour beers at all, and I was completely surprised after I picked myself off the floor from the tartness of it that I'm with Lena. I think it's really good. So if I was evaluating it against other sour beers, it's probably one of my favorites, and I would give it 9+, but I'm not going to give it 9+ because it's still a sour. I'm going to give it an 8.5. It's very drinkable though, which is very unusual. Usually, like a sour beer, you just you have 3 sips and then you got to throw it away.
You know what it reminds me of? It kind of reminds me of, I don't know what they're called. I think they're called icebergs or whatever. You get a beer and you get like slushy margarita mix in it.
Yeah,
that's kind of what this reminds me of.
The common one is that they do is they'll throw the Corona, a Corona bottle upside down into a slushy mix, like a lime slushy mix.
It kind of reminds me of that, but it tastes like summer.
Yeah, it's sweet. It's you know what? What scares me about this is it tastes like most sugary alcoholic beverages, which give nasty hangovers.
Yeah, it's probably got like 1,100 calories or some crazy number. I'll bet.
Oh, I
bet you pound 3 of these back. Next morning, your head's gonna be pounding, and you never even got a good drunk.
Yeah. My God, Patrick! If there's ever a Patrick line that we should like immortalize, that's the one. And you never even got a good drunk. God, like Leonard Kenny phoned up and they wanted that line for you. I had a situation once where my wife and I went to one of those tasting menus, and we decided to do the drink tasting menu.
Oh yeah.
And they did the Riesling wine, and like it wasn't all Riesling, but I can't. That stuff's terrible. It's so sugary and it's like awful. And I completely agree with Patrick. You wake up the next day and you're just like, if you've managed through the diabetic shock, like it's not good.
Don't you drink Riesling like you drink port kind of? You just drink a little bit at the end kind of thing?
I don't think they served it with the actual meal.
Oh, I don't know. Yeah.
Because like for me, I love like a really dry wine. That's how I usually like it. So I would agree that with Patrick that this is the real problem. Like he talked about the fuzziness on his teeth. I'm pretty sure that's sugar.
Yeah.
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 But I still
it's
love it.
definitely
Anyways,
amazing.
big thanks to Paul. We always love new beers.
I just like the
Fun one to
slice
try.
of summer in this horrible winter we're having right now.
Exactly, but it's not any. But Winnipeggers, we'll drink Slurpees in the winter.
Yeah.
Any time is a good time for a Slurpee.
Awesome.
All right. So,
All right.
anything new and exciting happened to anyone this week?
I watched Dope Sick as your.
Oh, did you
as
like
per
it?
Your, oh my god, it was so good.
Yeah, it was really.
It was
good,
so.
wasn't it?
I think I blew through it in like a couple of days.
Yeah. No, it was really, really
Fantastic.
Yeah.
Fantastic show.
Good. For those who don't know, Dope Sick is the story of what's the family game? The Sackler
family, yeah.
With the Oxycontin, and it's fascinating. And I thought that Michael Keaton did a great job.
Oh, he's amazing in it.
Yeah. Like, I
Yeah,
keep
really,
thinking
really
about
good.
Mr. Mum whenever I see him, but otherwise, I love it.
But yeah, it was a really, really good
That's
show.
funny.
I would
The,
highly recommend.
Yeah, the Mr. Mum. The greatest line in there is when someone comes over to check him out because he's not taking care of the kids properly, and he says, "Would you like a beer?" And the guy says it's 7 a.m. He says, "Scotch." That's Patrick's kind of guy.
Yeah.
Yeah, there you go. You need scotch to survive in this winter up here. You know, it's like I got off that plane from Houston, and it's like it was like -6 degrees, not a lot of snow on the ground. I'm like, okay, this isn't so bad for January. Everything's fine. Like, I literally walk in the door, I go crash. The next morning,
surprise!
It's like a freaking blizzard dumping 2 feet of goddamn snow. And it's been freezing ever since. It's like, get me the goddamn hell out of here. Like, I didn't sign up for it. I spent 2 months in Barbados last winter, and it's like now I'm going to be a snowbird. This is now for sure. Like, it's.
But we haven't had this much snow in a long time. I feel
It's
like,
really
I
not
think.
that much snow, guys. You guys
We just haven't seen it in a
Like-
long time, and it all kind of happened.
You clearly
in like
don't have
couple
a
of
big
days.
driveway.
I
that you
do
have to
actually,
shovel.
but I have 3 teenage kids. Or not teenage. I
Oh,
have 3
there you
young
go.
Well,
kids.
So
there you go.
No, actually, I went out and I had to shovel it, and I thought I was going to have a heart attack. 'Cause I literally was out there, and we were shoveling to get one of the cars. It's a long story, but anyways, you know what I did, Patrick, to save myself from shoveling? I took one of the cars in to get serviced. And then the guy kept phoning me, saying, "Come get your car." And I'm like, "Yeah, okay." Then he's finally like, "You got to come get your car, dude." And I'm like, "Ah, damn! I was hoping it would the snow would be gone." So I go get the car, and then I have to shovel out like a spot for the car.
A spot for
Oh,
it.
And
jeez.
so the 3 of us went, and, me and 2 of my kids. But I literally felt like I was gonna have a heart attack while I was doing it.
It was a lot. It was a
There
lot.
was a fair bit of snow.
It was heavy snow too.
Yeah.
Yeah. So, anyways, but it's really like, you live in Canada. You should expect this. It's like
I just feel like it's just compared to the last few years, it's a lot more all at once.
yeah.
Right.
But we've gotten so soft, right? Like in the
Yeah.
old days. So for those who don't know, there's Toronto. It has islands out in front of it, and there's an airport on one of the islands, kind of like. Is Chicago Midway like that? No, Midway's just out in the middle of nowhere. Anyways, we just have an island airport, and then there's some islands where people live. And in the old days, you used to be able to skate back and forth from there.
On
And,
like really on the
yeah.
lake?
Oh no, there's pictures of
Damn.
people
Oh,
skating
shit.
in like the
Okay.
70s or 60s. I don't know when it was. So obviously it was much colder back then. What amazes me as a Canadian is that every now and then, there's a place up in Georgian Bay. It's called Sainte Marie among the Hurons, and there was these people that came from France, and I can't remember what the year was. Let's say it's 1600, and they show you how they live, and you're just like, my God. Could you imagine coming from like the south of France to this new country? And everything's going great in the summer. It's all looking fine. There's a little bit of extra bugs, but otherwise you're like, great. You know what? There's lots of fish and stuff. And then winter rolls along, and you're sitting there, and you're just like, I think like 75% of the people died in the first year.
Oh jeez.
It's just brutal. Or how about being one of these people that you're like, let's face it, we have a lot of Scots and Irish, right? And it's you're Irish. The potato famine hits, and so you take up and you go to Canada. Everything's going to be great. You get there, so it takes you 2 weeks to get here or whatever. You get there, and then they go, great, you got 100 acres, but it's in Lethbridge, Alberta. So you finally go there, and they give you these 100 acres. It's covered in trees. And like you only have 2.5 months to get it right.
my God.
Like, can you imagine how tough it must have been?
Yeah.
I would have
yeah.
just walked down to California or whatever. Like, I would have been an American for sure. Like, there's a reason they never invaded. It's so bloody cold. Why bother?
Doesn't make sense.
Like-
It just does not make sense.
For those who don't know, I think what percentage of our population is within 100 kilometers of the border? I think it's
Some stupid like 80 plus.
I'm
yeah,
sure
it's
a
like
lot.
85% of
Yeah.
Canadians live right on the border. Like we're all just like huddled up on the border trying to be as warm as possible.
Yeah.
All right,
well.
guys. Listen, I got to wrap up because I got to get going. But
Okay.
it was a great session.
It was good. Everyone have a great
Yeah.
week. See you next week.
Yeah.
And
All right.
Have a weekend.
take care, everyone.
All right. Take care. Cheers.